Hey, Michael, how's it going, man? Mike, you there? I think you're on mute.
You're right. I was on mute. Sorry about that. Can you
It's
guys hear
all
me
good,
okay?
man. Yes, how are you?
I'm doing okay. I'm grabbing a salad as I wait for my car to be repaired, so I apologize, guys.
No, no worries. Figured it'd be nice to probably talk to you, just given all the different things that have happened, and then we have a big week ahead of us with PPI and CPI as well. So, just kind of want to hear your thoughts on the markets. I'm not a geopolitical expert, but I'm focused on the markets and a student of the markets. So you have more experience, so just kind of want to kind of hear your take as things kind of unfold this week.
So I've said this in a couple of places, including Tier One this morning, and unfortunately, I think this is largely playing out in that manner. Um, as terrible as the events that have occurred in Israel and the Middle East are, and the loss of life is tragic. The attack was brutal, regardless of where you fall on the political spectrum. I think we can all agree that attacks against young people, civilians, old people, women, etc., are generally not something we want to embrace. Um, but unless it actually meaningfully affects U.S. employment, unless it meaningfully causes people to change their allocations, and we may be seeing just the tiniest portion of that in the bond markets. Like I'm tempted to jokingly put out a tweet on the U.S. 2-year bond, which is up, you know, 7/30, 0.24% basically. Um, that like this is what happens when you get war in the Middle East, right? This is just a very uncertain response to terrible events because it's not at all clear how it affects the underlying, what I would describe as the fundamentals of the markets, the flow from U.S. Employees into their retirement accounts, institutional reallocation, et cetera. I'm not sure what happened today, or more accurately, this past weekend, causes that change in positioning. We really need to understand better whether this is going to escalate and whether this is going to manifest itself with much higher energy prices that in turn could create further distress for households and consumers in the United States. But for right now, the markets are doing almost exactly what I would have expected on this event, which is basically going sideways.
Yeah, looks like the bond markets are closed as well, so that may be something that we'll wait and see on tomorrow. David, I see you're on some questions from Michael, so go ahead, David.
So my question is, one, do you think that this environment and this situation was caused by the increased inflammatory type situations and geopolitical situations that we were in due to the Ukraine-Russian situation? And then two, are we walking into more increasingly tension type environments? And on that sense, what is that going to indicate for commodities outside of just oil? I would assume that has something like a precedence towards precious metals, as well, as we see in times of conflict. Precious metals tend to have a form of impetus, right?
Well, so yes, I mean precious metals tend to get a bid when real rates fall. The primary reason for that is that you see an inflationary response associated with war and uncertainty about even the status of the world's reserve currency when you see an expanding conflict, right? Unfortunately, war has uncertain outcomes, and as many people have pointed out far better than I ever will, gold is one of the assets that benefits from uncertainty. What do I do? How do I step myself out of a situation in which somebody is on the other side of the liability, right? Gold is somewhat unique in that you take possession of the asset and nobody else can actually say whether they're going to deliver it to you or not. That's at least the physical manifestation of gold. Futures are a little bit different. ETFs are obviously a little bit different. But in all situations, we're just kind of trapped in this. We don't actually know what we're looking at here. It's very easy to say that this is going to escalate. Many people on Twitter, I think, have correctly pointed out that this opens up additional fronts in conflicts that the U.S. is at least peripherally or in a proxy manner involved in, whether that's Ukraine, whether that's interactions with Iran, whether that is our relationship with Saudi Arabia. All of those are increasingly into question, and I think those who I think are approaching this in the most thoughtful manner are really trying to understand what does this actually mean in terms of an expansion. And until we know that, I just think it's premature to jump in any one direction. Um, the underlying conditions of the expansion of U.S. deficits, the increase in the supply of Treasury bonds, which are driving real yields. I think it's important for people to recognize that the move that we've seen in interest rates has been a real interest rate increase, not an inflationary response or an increased expectation of inflation, which seems to be the narrative that people have grasped onto, right? The idea that oil prices are moving higher in a structural fashion, or that the US government is going to increase spending in a systematic way and is unable to control its budget. All of that should be coming through the inflation signal, but it's coming through the real side of the equation. That in turn tells you that this is more a function of the market not being able to absorb the increase in supply in treasuries that is coming, rather than the perception that the economy is incapable of handling the increased levels of spending. And I just think that's the single most important thing that people really need to take away at this point. I wrote about this this weekend in my Substack, that there is a very tangible and explicit role for bonds in portfolios because of their unique characteristics as being the only assets where we have virtual certainty as to their terminal value. That means their payout structures are different than almost any other asset that is out there, and they play a role in a portfolio whether you believe in them or not because of that dynamic. We just are not yet seeing the ability for the system to reallocate across different assets yet. And so I think everything that we're receiving, while there are economic signals attached to it, I think it's very premature for people to make arguments that we've entered into a structural environment in which the U.S. inflation is moving dramatically higher. Again, not being priced into markets. If you think that's the case, you can make an explicit bet, and some of the assets that are out there are attractive.
I think we
Yeah,
lost you at saying
yeah,
some of the assets are attractive.
yeah. No, I think some of the assets, particularly the really attractive.
And I think that, again, we slightly lost you there, but I think that you're highlighting a key point, right? And the consistent and consolidative nature that the fixed income represented, in the sense of like aggregate supply and demand in relations to fixed income issuances versus that of the actual accounts, and specifically larger institutional accounts that would absorb it, and government accounts, right? We knew that 66% of the majority of the fixed income products being issued by the United States is being absorbed by the major institutions. And so what do you think is going to create a form of equilibrium, a balance back within actually the yield curve inversion? Like this is a hypothetical question, evidently, but I still think it's important to highlight that the key factors to see, one, if we're going to see a bear steepening or a bull steepening. We're obviously starting to see a bear steepening where the long end of the curve is starting to meet up the short end of the curve, and I think that that's a formal dangerous sign, and correct me if I'm wrong there.
Well, again, I think the answer is we don't know, right? I mean, there can be a bear steepening that's tied to expectations of much stronger growth. There can be a bear steepening that's attached to the inability to absorb supply. I think we're seeing the latter. I think the irony is, unfortunately, that the situation as it exists right now is that there's very few institutional investors in particular that are capable of making structural changes to their asset allocation framework to reflect the very different prices that we're seeing. We'd like to believe that everybody dispassionately evaluates all opportunities placed in front of them at every point in time. The problem is that's simply not work. That's simply not the asset allocation process. I've illustrated this by giving people the example of a target date fund, which literally return stream in terms of its potential attractiveness. Right? They're locked in mechanisms. that define exactly how many equities or exactly what proportion you're going to be in equities, what proportion you're going to be in bonds. And those are largely inviolable to fundamental changes, right? So if interest rates were to surge overnight to 100%, the irony, of course, is that bonds would be immediately hammered, but any rational human being would run out and buy bonds hand over fist with that sort of return potential, particularly if that were expressed in real terms as something that's inflation protected, for example. Um, a target date fund has no capacity to make that change. It has no capacity to absorb that. So ironically, as interest rates go from negative to very positive in both nominal and real terms, there is no capacity for rebalancing. Now we're seeing the household sector rebalance. We're seeing this through reduced demand for credit. We're seeing it through increased demand for cash balances. We're seeing it through money flowing into money market funds. And increasingly, we're starting to see it flow into bond vehicles. But this is coming from a discretionary component of the household market. We're just not yet seeing that on the institutional side. It will occur, right? There is a point at which institutions will start to say, hey, wait a second, we can achieve all of our objectives with no incremental risk. We can actually lower our risk profile dramatically by buying bonds. If the economy begins to slow or the evidence of that slowing becomes clearer to the Federal Reserve, again, it's very clear to me, but that doesn't mean anything in the context of the world. But if the Federal Reserve starts cutting interest rates, perversely, that re-steepening of the yield curve that you were describing before, particularly if it happens in the form of a bull steepening, meaning 2-year or 3-month rates begin to fall, then you're actually going to see a dramatic change on two fronts. One is suddenly people are going to start to consider the reinvestment risk of their short-term paper. Right now, I would suggest that many, particularly in the household sector, look at higher for longer as a gift. Isn't this fantastic? I can hold cash in a money market account and earn 5+% as far as the eye can see. If those rates start to get cut, you'll see people rotate out into bonds for two reasons. One is because they're trying to remove the reinvestment risk. What happens if my bond matures or my bill matures and interest rates are markedly lower when I go to reinvest? The second thing that happens is it becomes much easier to finance longer tenor bonds when the yield curve is steeper. If it costs me 2 percentage points to finance a 30-year bond by being short the front of the curve, that's great. But if it costs me 5.5 to finance the front of the curve, and the back end yield is, for sake of argument, 4 or 5%, that actually has negative carry characteristics on an apples for apples basis, makes it harder for people to step in. And so I keep looking at this and saying, eventually we'll see that demand emerge. Combination of the ability to finance it and people waking up to two components. One is that the dramatically higher level of interest rates makes bonds empirically more attractive than they've been in the past. And the second is the demand that emerges from the improved capacity to finance it.
And I think, and you mentioned a many great deal of points there, but one key thing I'm going to say is the discretionary move towards money market funds and the potential shift institutional players are going to have to do in order to reattract the outflows that they're seeing within their own, let's say, stagnant flows and or accounts in that sense, building them their AUM. And do you think that in that sense they have a lack of responsibilities in saying, I want to create this consolidativeness because it's reaping me my profits, it's giving me the business that I currently have, and the market is not reacting in the ways that I would have initially thought within a real yield environment, right?
Well, again, my pushback becomes, one, I want to make sure that when you describe that from the institutional framework, that we're not referring to it in a fiduciary sense, right? I don't think investment committees are quote unquote doing something wrong. They're not actively trying to make a mistake. If anything, they're trying to take the lessons that they've learned over the last 30 years, which is don't overreact to any one piece of information, right? And trying to put that in practice. And so they have model portfolios that they have carefully constructed in which they have articulated a point of view about an expected return profile. And to radically change that allocation in relatively short time periods both exposes that manager to the risk of losing their job should they get it wrong. But equally important, like they could get it wrong and just end up hamstringing the expected performance associated with the portfolio. Now, I personally think that that's wrong, and that we will ultimately begin to wake back up to the idea that asset classes don't have an endogenous return. In other words, stocks for the long run doesn't always mean you're going to get 8.5 or 11%, as Vanguard might present it. Instead, it means that, hey, that's what the return profile was. And our mere expectation of that, if we think equities deliver 8 or 11% a year over long periods of time, the belief in stocks for the long run causes people to over allocate to equities. And at least under a long-term model, a truly long-term model that's not just incorporating or experiencing the benefits associated with the shift towards the asset class, it suggests that the long-term returns are going to be lower. But that's a prospective statement. I have no prospective, right, with an O. I have no proof that equities are going to offer lower returns in the future because I can't offer that. The future has not occurred yet. And who knows, maybe we'll walk out of this with the S&P trading at 60 times earnings, in which case earnings, expectations for realized returns would be better than I would have expected under these conditions. And so this is a really challenging environment, right? We all live in an environment in which we fully acknowledge the legality of the statement that past performance does not predict future results, and yet we build model portfolios, we build portfolio allocation systems that largely are built on the idea that assets are going to return what they've returned in the past.
And not to reiterate, but this is why I said the lack of responsibility. It's not towards the lack of good work that's presented within the very structured prospectus in the sense of predetermined profits and investment structures that they're going to indulge. So long story short, I think that's where one key thing that you said earlier is the lack of flexibility within the environmental shift in identifying the actual profitability and or investment structures that would be more, let's say, beneficial for one's, let's say, retirement account in that sense, right?
Well, when you say more beneficial, again, these are statements about the future that we can't possibly know, right? We can form opinions and we can build fact bases to support our opinions, but ultimately, knowledge of the future can't exist, right? Mere insights around how things have behaved in the past changes our behaviors in the future and therefore creates very different outcomes. I don't think anyone in their right mind would have looked at the world in March 2009 and predicted a scenario in which, a regular exchange on Twitter would be something along the lines of, well, bonds are terrible and equities are safer, right? I mean, what a radical shift in behavior over the past 14 years. If I compare where we were then versus where we are now, this is, the polar opposite. By the way, I mean, same underlying phenomenon. If we had gone back, so, I'm seeing headlines now that compare the drawdown in bonds to the drawdown in the NASDAQ in 2000. Right, and I think that there's actually a lot of similarities. As you know, David, I talk about 2000 as being basically indexing 1.0 and many of the problems that were created around that. I genuinely think part of the reason why bonds got so extreme, particularly bond indices, got so extreme was because of the mechanics of passive penetration into fixed income indices. They buy more of what goes up. That creates an environment in which you're cutting interest rates. The longest, lowest coupon bonds perform the best, become the largest portion of the index, and perpetuate that perception that, 4 years ago, go back and look at it, right? The headlines were, we're in a permanently lower negative yield environment. Negative nominal yields, negative real yields are something that we should be considering being part of the long-term reality of the market. That was the perception that we had just a couple of years ago. Today, people look at bonds offering significantly positive yields, right? I mean, I don't care what CPI you want to use. There is no CPI in which you can look at the front of the U.S. curve or even the back of the U.S. curve at this point and say that they are strongly negative real rates. under those conditions, like, we should be thinking about how we change our allocation, because the opportunity set has meaningfully shifted, but it's largely meaningless in terms of actual behavior from people. Very few people, and that's to their benefit so far this year, have the flexibility of swapping out of equities and into bonds. They just don't. Like, how do you do it in a target date fund? How do you do it in an institution that has a model portfolio that requires an investment committee getting together to discuss it? How do you do it in an environment in which, the insights associated with David Swenson and the endowment type model, where our real benefit is holding stuff for the long run? How do you turn around and explain to those individuals or to those portfolios that when you look at private assets, they're marked at huge premiums to their publicly traded peers, and therefore that premium that they earned in the past should actually be negative? Nobody has the capacity to meaningfully evaluate that without taking tremendous individual risk. And I joke about this all the time. We talk about compound interest being the most powerful force in the universe. That is wrong. The most powerful force in the universe is liability avoidance. I don't want to be blamed. I don't want to be responsible, right? The buck stops here in terms of, the Truman slogan. When was the last time you actually said, hey, it's my fault?
Yeah, and honestly, Japan could be a very good illustration to that development, especially on a fiscal and business type, administrative type manner in that sense, right? And I think that we're evolving there. That was just a small little caveat joke, because I would agree. And my question is it then healthy for these individuals that said they were restricted, in essence, to move their capital from these funds, and then to their benefit, as you said, it essentially allowed this consolidative nature towards markets? And my argument is March 6, 2020 actually was a huge demonstration of how strong these passive flows actually have within the consolidativeness of market participation. The V-shaped recovery, walking into, after all of the liabilities of margin compression that occurred within the big market breakers and circuit breakers, essentially those passive flows said, I'm not going to allow the market to degrade more than this. And then we allowed it to then avail to 2021, right?
Well, so when you say allowed, right, I mean, I just want to emphasize, I don't think any of that was quote unquote allowed or thoughtful in the way that you're describing it. It's just
Allowed
mechanical.
by exactly, allowed by it's a mechanical systematic
Right.
process that you described since 2000, and the evolution of the passive flows that just essentially come into support.
Right. I mean, just remember that this is largely a mechanical system. If you put money into it, what do you expect the behavior to be? And so many of the actions we've taken since 2018, like, I'm actually very much struggling with how to articulate many of these points, because if you go back and read, like, I encourage people, just Google 401k outflows, right? And what you'll see in 2018 is that we moved to theoretically a structurally negative environment in which the boomers retiring was going to end up taking more money out than was going in. And in the past 5 years, we've changed virtually every rule governing 401k flows. Right? We moved from required minimum distributions happening at the age of 69 to 70.5, then to 72. Now we're moving to the point where many of these flows have no required minimum distributions until you die, and then the death, excuse me, the death payout occurs over the course of roughly 10 years, right? So, like, we've radically changed this. We've increased the proportion that people were able to contribute, particularly for small businesses. We then went a step further through ERC fraud and basically handed a ton of money to small businesses that they could in turn flow into the markets. The thought process of U.S. government debt, we often think about that as U.S. government borrowing. One of the points that I try to raise for people or emphasize is that the more accurate way of thinking about debt on a sovereign basis is effectively the issuance of equity, right? And so you actually see these tensions when you think about the productive capacity of the economy, its ability to support a debt load, and how that typically leads to much lower interest rates, right? Simply issuing debt doesn't actually change the aggregate income of the country. We actually see this in the data sets that you'll see. Lacey Hunt does a good job of highlighting the lack of productivity of debt issuance in terms of growing GDP, right? If we just issue debt and we just transfer that money to people, well, that's a non-economic activity that adds no productive capacity. It's equivalent to issuing shares, for totally pointless purposes. What does that do? It lowers your capacity to pay dividends per share. That's where we are in the debt cycle right now. We do not have a smart investment plan for how we're going to spend the proceeds that we're spending from the government. Far too much of it's going to transfers. Far too much of it's going to largesse to those who already have money, offering them, fake incentives to invest. Um, and the natural consequence from that is diminishing productivity of those expenditures, and ultimately lower debt capacity for the U.S. government, which has to ultimately manifest itself in higher taxes and lower interest rates.
So going into a more fiscal austerity type environment, and specifically small businesses, especially when we're looking at our tax rate, right? It was only personal tax that it grew in the sense of the last 15 to 20 years. And if you're looking at corporate taxes, I think it only grew at a nominal rate of 1.2, and even lower in that sense. Personal taxes are the largest encompasses. So would you then foresee that would occur? And then to go back to, I guess, aggregate demand of bonds and the whole developments, would you then think that I forgot the second question? So if you just don't mind answering the first question, and I'll go back to the second question. Sorry about that.
Sure. No, I forgot the first question. So I'm joking. The Everything you just described actually has a meaningful change on asset allocation if we allow it to. Right? If I raise corporate taxes, all else equal, that makes it harder for equities to return significant capital, particularly in the form of share buybacks. If I increase interest rates, that all else equal makes bonds more attractive relative to equities. If I spend that money unproductively, it doesn't necessarily create significant growth in GDP, which in turn can manifest itself in higher corporate profits, meaning that there's less left over in the residual asset we call equities on a fundamental basis. So all of these things ultimately that you're describing, again, suggest that bonds should be increasingly viewed as the dominant asset over equities. But until people change their behaviors or sit down and actually recognize that, holy cow, I can actually secure retirement using fixed income, which dramatically reduces my uncertainty, right? Until that actually occurs, I think the technical term is you're pissing in the wind.
And it goes to my second question. Thank you for mentioning it as well. Like you were mentioning the erroneousness of debt to GDP, and how, in fact, the lack of economic productivity that this debt issuances is going to actually have. I would then assume that GDP is essentially going to either stagnate and have a larger effect to not produce, or we're not going to be producing as much in that sense because of the lack of productive output the debt is actually going to have. And I would assume then that would then include lack of consumption, right? The propensity to consume is going to lower, and the propensity to save within your fixed income environment is going to increase, specifically considering if real yields stay within this type of situation, right? Hopefully this idea that bond environment, fixed income, is actually the area that's going to output most, how can I say, risk-free earnings and yield within this environment.
Well, I think what many people who immediately jump to bonds must be unattractive because inflation is structurally rising, what they effectively are immediately jumping to is a hyperinflationary type environment in which savings behavior radically changes. So people stop saving financial instruments because they actually doubt their viability in the future, and they begin saving in quote unquote real assets, right? You start stockpiling food and copper and items that can be sold in the future. Classically in Germany, in the German hyperinflation, men's hats, became very well did. Those types of behaviors, I think we just don't see evidence that that's the case, right? We're not seeing people build inventories. If anything, we're seeing people try to deplete their inventories and work down the assets that they've accumulated, the higher cost assets, in many situations, particularly if I look at things, I mean, I'm just going to be absurd and highlight something like eggs, right? The prices have largely retreated. If I look at copper, the price has not behaved in the manner that many who are forecasting shortages had anticipated. In fact, if we look across the commodity sector, I would point out that really the only thing that is really rising in any meaningful way is the artificially restrained oil, in which Saudi Arabia has effectively made a bid for a cash neutral transfer by cutting production of oil and then offering to sell people shares in their oil production company at inflated prices, right? To me, this speaks to what a paper tiger Saudi Arabia actually is, because what they're doing is they're raising prices for a good that ultimately we want to use less of anyway. And so they're just expediting that process and trying to effectively create a cash neutral environment in which their leadership can continue to spend on absurd things, by offering us, ownership in the company that produces that. And don't kid yourself, we don't actually have any ownership there. They don't have the rule of law that we would like them to have, and I think that's ultimately one of the reasons why you're seeing emerging markets struggle. Is this increasingly people are recognizing that the validity of those claims is absolutely in question. Right, this is particularly true in China, but I think it's also should be considered to be important across many other regimes around the world right now.
And I think mentioning China, especially the bullishness that the mainstream media has had surrounding China, one of the largest dangers, and it's one that's not necessarily mentioned, and it's my opinion, obviously, but it's the fact that it's a CPP, the Communist Party of China. Fundamentally, they activate and they participate in a different economic type format, and they then try to create, since the 1990s, right? We have many articles within their interactions and within their agreements into NATO and to the free trade agreements that they had to organize and participate in very fundamental manners. And they deviated it with, let's say, how can I say, backwaters type tactics in order to mitigate their front face. But in the back end, they would always try to undergo different tactics in order to profiteer, i.e., the 1992 papers describing the actual military trade that they would have in associations to majority of African states and again Iran. And so we understand that China presents a unique problem in that sense, right? And most investors, especially when we're looking at passive flows, don't even realize that danger that's isolated and the risk that's enveloped within China. I mean, I'm just going to point out, like, the one restriction: I take all my investors, my foreign investors, as the Chinese government, and I restrict all capital outflows, like I would, like Russia did during the incursion. And then right away, we have a huge effect within world economic activity. Correct me if I'm wrong there.
I don't know that I would say you're wrong. I mean, so one of the challenges, from trying to operate from long time horizons is that it often leads you to a conclusion that something is unsustainable and therefore not a legitimate threat, um, even while those who are involved in creating that threat don't see it that way and therefore become a threat, right? Classic example I always cite for people on this is Leon Levy, who founded Oppenheimer, wrote of his father, Jerome Levy's, assessment of the Nazis in the 1930s and came to the conclusion that Germany was bankrupt and therefore, if we simply waited, it would ultimately not become that big of a problem. And he was 100% correct, by the way. Like, the German government was largely bankrupt. It just chose to impoverish its citizens to an extent that seemed unfathomable. And that's really the critical thing to remember about China is that while the individual Chinese are not wealthy, the country of China, in terms of its command of resources, if it puts its mind to bad behavior, can engage in bad behavior for a very long period of time before you deplete the resources of the country to the point at which it has to change. Right? I mean, as Americans, we take horrible offense, and I'm not being dismissive on this, right? But we take horrible offense if our purchasing power is lowered by 5%, right? But our purchasing power relative to anything that almost any other society or our ancestors had, is so high that, like, it's very easy for us to make fun of groups like the millennials and be like, just give up the avocado toast and you can afford to go to school and buy a house. those are just not realistic statements in a lot of ways. And so the real risk I think that you run with China is that there is no mechanism to force them to change unless we ourselves are willing to make sacrifices in that process. We were willing to do that in the 1930s and 1940s when we engaged in things like price controls, when we engaged in rationing coupons, when we engaged in all sorts of things that lowered the standard of living for US citizens to allow us to conduct policy around the world in a manner that did nothing to raise the immediate standard of living for US citizens, right? Really hard thing to push through in a society that is as divided as ours currently is. And so, how that resolves itself, like I think it's, when we talk about it being unique, I'm not really sure I agree with that. I think that we're actually repeating a pattern that we've seen played out over and over through history. Um, it just takes on its own unique characteristics because of where we're coming from.
Yeah, it definitely the my how can I say formal youthful ignorance in that play might not be unique as to the total like historical developments in that sense, but I do think that when we're looking at the lack of responsibility the United States had within the one free trade agreements, NAFTA agreements, and the non-worker protection program that was initiated within the cost of labor, the cheaper cost of labor in these foreign economies, essentially hurt the United States on a longer term. And it was only a butterfly effect where now today we're living those effects, right, of the lack of responsibilities and policies that we were enacted within those times, especially 1970s towards 1990s, right? And then the expansion of the supply chain, and then the isolation of the U.S. worker and the lack of ability for the U.S. citizen to say, I'm now going to have this American dream, and isolating the destruction of the 1960s American dream, if you will.
Um, so I think what you're alluding to is that there are deep-rooted separations that exist in the United States economy, in part because economics was way too dismissive of the difference between theory and practice, right? I mean, I've guided people to watch the analysis of NAFTA by Sir James Goldsmith, which is just one of the most brilliant. Like, it's out there. Somebody can probably find it and tweet it into the space.
It's the exact one I was referencing. I will try to find it. And yes, Sir James Goldsmith was ingenious within his descriptions there.
Well, see, but this is actually part of the problem. Is that at the time, the Paul Krugmans, et cetera, of the world were very quick to say, well, everybody gains under free trade. And it doesn't sound like that's a crazy thing to say, but it actually is a stupid thing to say, is really kind of the most important observation I would make, which is, no, on average, everybody gains. But that's a radically different statement than everybody gains. Right. And what we didn't do as a society is recognize the sacrifices and lack of adaptability, really, that many people have. Right. We talk nonsense like worker retraining programs. The great fantasy in the 1990s is people will switch from being automotive line assembly workers to, MIS directors in large corporations. Like, it's just dumb. Right. It's really dumb. I mean, I'm 53 years old. I will tell you that the plasticity of my mind has degraded radically versus what it was 30 years ago. My ability to transition into any number of careers at this point, including probably being a young father, is totally suspect, right? I'm rigid, I'm set in my ways. Like any rational human being would look at me and say, the guy kind of knows how to do one thing at this point, right? And even that, it's debatable how well I know how to do it, right? I was on a podcast with Andy Costan at Damp Spring on Twitter, and he and I were both commenting, like, we've been doing this for 30 years, and we don't know if we produce alpha, right? I mean, our track record suggests that we do, but that doesn't mean anything about going forward. And the reason why I'm emphasizing this is because, like, we approached this whole thing of, hey, let's just ship jobs from North Carolina to China, or let's ship jobs from Michigan to Mexico or Southeast Asia or elsewhere, and consider that as like a prima facie evidence of like everybody's going to be better because you can buy cheaper goods at Walmart. Well, it really hurt our society, and it left a lot of people feeling very ignored when their complaints were met with, well, that's just your fault for not really getting your act together. And that's just been magnified by the political discourse, which weirdly has taken the form of the pseudo-populist Democratic Party from the 1960s has turned into the one that is talked about people as deplorables, while the business-friendly Republican Party is the one that's theoretically embracing the damaged factory worker. Like, this is just one of these weird flip environments in which it doesn't feel like anybody is capable of doing anything other than behaving in a tone-deaf manner. And that's probably true for me as well.
And another question that Sir James Goldsmith actually brought up, right, was the stagnation within a government policy, right? Do you think that we're living that now, in the sense that because of the fiscal environment that 2008 created, 2010, in the very restrictive deficit expenditures, in the sense that I can't redact any formal deficits that's added within my government expenditures, and then now we just jump to today with Kevin McCarthy being Kevin McCarthy, the House Whip not being able to do anything, the fiscal dominant regime that was represented throughout that environment. Do you think that we're living in a very stagnated environment where certain individuals, and I don't mean it in that way, but are able to profit because of that? And it's only now where I'll allude to Jamie Dimon saying we're only now walking into a new regulatory environment, especially within these institutions, right?
Um, I think it's. I think it's. I'm just trying to think about how to say this again without offending every possible player in the room. We've been in a radically different regulatory environment by and large since the early 1980s, in which the general perception has been deregulation is the path that we all want to follow, that we want to put more and more responsibility in the hands of the market. That takes the form of defined contribution plans as compared to defined benefit plans, right? Which tells people that it's your responsibility to ensure your own retirement. Some people are going to do that very well. And some people will be able to take advantage of loopholes in that process to put billions of dollars into 401ks. And others are going to struggle to put any money aside. The dignity associated with the statement that all men are created equal and that everyone has human rights, etc. Like, in a weird way, like as an uber capitalist, I also have to sit there and say part of the process of capitalism is allowing people to take risk, with an element of that risk being socialized, right? Like, if I want to be Henry Ford and I want to be a crazy guy, building and failing over and over and over again and ultimately succeeding, society has to recognize that it has to socialize some of that risk. And the language that has largely emerged is, and people use this very well: losses socialized, gains, kept privately. That's the underlying model that we've been in for an extended period of time, and I just think it manifests itself in everything ranging from the way we handle antitrust and the very explicit price-setting behaviors that we're seeing, facilitated by things like software. I mean, the work that Matt Stoller is doing, and again, I want to emphasize, like, I am about as economically conservative as they come, but remember that the actual process of capitalism requires you to break up anti-competitive behavior. And anyone that looks at the underlying conditions in Web 2.0 and the dominance of Google, the dominance of Amazon, the dominance of Microsoft, the dominance of Apple, their ability to control the environments in which they operate and prevent competition, in my opinion, is actually materially harming us. But boy, do they look successful, don't they? Right? This looks like the winning formula, and so everyone wants to replicate that without considering the counterfactual.
Some great points here so far by Mike Green. I'm glad we've been able to get him on so impromptu. And I see Benjamin's on here as well. I know he has some questions and thoughts he'd like to run by and have a chat with Mike Green on. Before I do that, definitely give Mike Green and the rest of the folks up here a quick follow: David, Benjamin, Weimar, and the One Read. One Read's actually a free newsletter we run. So if you guys enjoy this free content, we send it in newsletter formats as well, where we kind of summarize what's going on in the markets. It's linked above. Quick, easy read. I'm sure you'll like it if you enjoy these spaces. So definitely check that out as well. But go ahead, Benjamin.
Hi, Mike. Thanks for being on. I'm curious. I know I've read some of your writings on the 60-40 dilemma. This idea that capital is fixed because of the sort of robotic systematic allocation between stocks and bonds that are embedded in whether it's a target date, whether it's a moderate portfolio index to 60-40. We do see it in the retirement plan space with this push towards low cost funds, including like CITs now in participant funded plans. Fiduciaries feel like as long as I get the lowest cost funds in there, index funds in there, I'm covered as a fiduciary. So my question is how, like, what do you kind of envision as sort of the breaking point in terms of how we might rethink this fixed capital allocation that's happening between stocks and bonds? And then a correlate to that is what we're seeing in the credit markets, because normally this kind of angst, anxiety, disruption that we're seeing in equities hasn't really translated into credit market pricing disruptions. And that's just because everyone's on holiday right now, so nothing is trading, and as a result, nothing's getting marked where it should be. But I'm curious as to what you kind of see as, this capital logjam that we're seeing taking place between equities, fixed income, and then secondarily in credit. What's going to break up that logjam?
So I apologize. I actually am probably going to have a little bit of wind noise. If it's unbearable, let me know. I'll switch off of my headset. But so you hit on a number of really important points. One is, remember that this concept of fixed allocations or specialized asset management is relatively new, right? When you look at Warren Buffett, he's owned every financial instrument under the sun and has earned the flexibility to do that, does so on a regular basis, sometimes successfully, sometimes less successfully. I'd point out that, one of the key quote-unquote innovations that occurred in 2006, 2007 was Warren Buffett. Let me switch off my headset. Give me 1 second here. One of the key innovations that actually occurred in 2006 was Warren Buffett, creating a synthetic fixed income instrument by selling put options on the S&P, the Nikkei, et cetera, right? This is one of the well-documented examples of him creating a synthetic security, even as he uses the language, derivatives or instruments of mass destruction. He ended up, of course, being right in that because it was such a disastrous trade for so many people that were involved in the process. And in classic Warren Buffett mode, structured the trade so that it worked out really, really well for him. But that type of dynamic is actually telling you that one of the key issues that we have out there is that there is a lack of innovation. There is a lack of people having that flexibility to approach things in a totally different way. And I would highlight that some of the instruments like crypto, for example, have actually done a pretty good job of trying to create alternative approaches, alternative vehicles that people can invest in. But for the most part, we've entered, the equivalent of the deep ocean, which is actually just a desert, right? There's very little diversity of life. There's very little difference where people basically are like, well, do I own the S&P? Do I own the Vanguard Total Market Index? Do I own the bond index? Do I own a bond ETF? Right? There's very little consideration for the richness of the investment vehicles that actually existed when I entered the industry, where you had everything ranging from convertible debt to preferred equities to all sorts of contingent collateral, all sorts of interesting stuff that is largely gone now in favor of things like structured products, which are really just a largely transparent attempt to convert equities into fixed income like instruments, because there is still a shortage of assets. that allow people to secure their retirement, which is really what investing is all about. Securing assets and purchasing power off into the future. So how that works through and how that changes, like, this is one of the reasons you hear me spend so much time criticizing and pushing back. Jeez, terrible connection. I apologize, guys. Pushing back so much on the loss of diversity and diversification within the investment world, right? Because what we've done is we've told people it's your responsibility, and then we've told them the only acceptable vehicles to do it are the same thing everybody else is using. That's a very fragile system.
And as a follow-on, then, do you see that dynamic taking place in terms of how we price risk in the markets, whether it's equity risk or credit risk? Again, I'm just kind of thinking of this buy the dip, it seems, environment that we find ourselves, particularly with credit, maybe outside of like stressed CMBS portfolios, but it does feel like that credit is being mechanically bought just like equities are.
Well, I think that's absolutely true, right? Because again, if I have a portfolio that allocates 5% to high yield bonds, it's going to allocate 5% to high yield bonds, regardless of the attractiveness of that underlying asset class. Theoretically, if those assets sell off, that automatic rebalancing actually allows me to put more money to work in that space because it is supposed to be more attractive, right? The problem is what happens in an environment in which the price falls, right? And I think this is what you're actually seeing in credit. You're seeing the price fall because of the duration exposure. So it's being treated as a riskless bond and then a risky component. So the price falls and I buy more because that's what I'm supposed to do on my rebalancing. But at the same time, the higher interest rates means that none of the companies are actually issuing. Right? Well, what that ends up with is very tight credit spreads. Even as the riskiness of the asset class grows. And I think that's what we're seeing. Now, the wonderful part about credit, and this is why almost inevitably problems begin in credit, or why they manifest themselves when people talk about credit being smarter, excuse me, is that fixed income and credit have a unique characteristic to them, which is they are finite-lived assets. And so there is a point at which the maturity hits and people need to evaluate the actual underlying. Basically, it's an IPO of a new security. And so when that happens, it forces people to actually make a very active allocation choice. And the repricing tends to occur there, often in the form of bankruptcy. So I think that's really the key in terms of why you see credit markets tend to signal these things, even as in the current market, right? The current structure or mechanical structure of the market, that can't really manifest itself until the very end.
Regarding your comments about systematic allocation and pricing, one could extend that argument maybe to the CTA space, the commodity trading advisor type portfolios that mechanically invest based on short-term price action. Do you see CTAs playing a bigger role in terms of day-to-day volatility or marginal pricing, or why would we look at CTAs differently than would we look at a kind of structural systematic allocation in asset classes?
So the quick answer is yes. I think, ironically, even as CTAs have shrunk broadly as an asset class after the terrible performance post-2005 adoption of commodities, and many CTAs effectively diversified into equity trend following, which tends not to work all that well. But as the asset class has lost assets, the inelasticity of the rest of the asset class, the rest of the assets has increased due to the growth of systematic strategies like CTAs or passive vehicles, etc. And by inelasticity, we're talking about the responsiveness of price to changes in supply and demand in the classic economic sense.
As you move to a more inelastic model, the impact of any marginal player becomes larger. And so I do think that they play a role in exacerbating some of the conditions that we talk about, as do vol targeting strategies, et cetera. But I wouldn't really put it at their feet and say that they're to blame for this. If anything, I think they're just one of many factors exacerbating these dynamics.
I know you participate with Tier 1 Alpha as an advisor, and on vol targeting, you've noticed that there's been this mispricing that's been happening between implied vol and option pricing versus realized vol. Do you see that persisting, or do you see that like correcting in a vol shakeout of sort of a way?
Right. So just to emphasize what Ben is hitting on here, and again, I apologize for the wind noise. But what Ben is hitting on is implied volatility has been consistently priced at a significant premium to realized volatility. That in turn has supported all types of vol selling activities, which at least theoretically should compress implied volatility versus realized volatility. But because of the way vol markets work, it doesn't actually have to do that in any time fast, right? So there's the classic expression, the markets can remain irrational far longer than you can remain solvent. You can bet on a blow up, you can be right about the blow up, but if your timing is off, then you lose, right? On the flip side of that, you can bet against the blow up, you can be wrong that blow up is going to happen, but by the time it actually gets there, you've made back all your money, and as long as you haven't invested in an overly levered fashion, you're likely to keep a fairly significant quantity of those proceeds. And I think by and large, that's largely what we've seen happen so far this year. Market players have bought shorter and shorter dated option contracts to hedge themselves against immediate events. And since those events haven't materialized, they've basically had to concede in a lot of ways. And now they're, in many situations, out of ammo. Ben, I apologize. Can you take over for a few seconds? I just got to finish a transaction here quickly. Thank you.
So, Rahul, I know this is kind of a last minute space. I have a podcast and I'm actually going to be starting in a half hour or so I can be on for about 30 more minutes. I do want to give a chance to other speakers like Weimar and David, if you're in the audience. I know bond markets are closed today, so it's kind of hard to sort of make any sense for at least what bond market reaction is to the tragic events that unfolded over the weekend. But it does seem like there is a flight to safety bid happening with bonds, although we are seeing equities rebound off the lows. Credit to several FinTwit personalities out there that said to fade the sell-off, which we're kind of seeing today, although I caveat that this is happening within the context of the bond market being closed. So not kind of getting a full signal. But Weimar, David, any big picture thoughts on risk asset pricing following what happened over the weekend?
I mean, one of the things that did kind of happen, although it's come back a bit, was gold popped. There was never really a move in Bitcoin, which was interesting. Beyond that, I think the Israeli central bank over the evenings pledged that they would do up to 30 billion in effectively dollar sales to defend the shekel, and then up to 15 billion in swap lines. It looks like they probably didn't have to use a lot of that. The currency has held up better than I probably would have expected, so that's been interesting. It'll be probably the biggest unknown in this whole thing is, does it spiral and how much does it affect oil, Strait of Hormuz, all that type of stuff. It's really a lot of those concerns around energy. I mean, Israel does have one major gas field offline now. Chevron announced this morning that they had idled it. So that's, kind of a regional impact, could affect Egypt and Jordan, but beyond that, it's tough to say. I suspect we'll see. Well, we are seeing a lot of military actions in Gaza. I think this might be a little more protracted of a conflict than people expect. Um, but anything can happen in these type of things.
Yeah, the bigger debate right now is whether it moves beyond the Levant into Iran. And if there is any sort of skirmish between Israel and Iran, what does that look like? Is it soft targeting? Is it going after other proxies, perhaps closer to Iran, or is there a direct military engagement with Iran? And so far, at least, the equity markets, the commodity markets are behaving like they see this as a limited conflict. Although this will obviously need to play out over the next week or so to see how protracted or how extensive this is. What I do find interesting is the natural gas markets actually reacted just as much as oil did. And it wasn't just local natural gas markets. You had Netherlands spot deliveries shoot up as well, even though European liquid natural gas storage levels are pretty much topped out at this point. So there are, I think, are some reverberations here
Yeah,
that
one
kind
thing
of
I'll
get beyond
say.
oil.
Sorry, I wanted to say one thing on nat gas because this is something I'm actually long right now. I've been following for a while, but right now I really like the setup. But one of the things that happened in Holland that people need to keep an eye on that was there last year that won't be this year. They closed a super major gas field called Groningen in Holland, so that's going to be a dynamic that they're going to have to replace that somehow because last year, according to the news, they went in pretty topped up on nat gas storage as well in Europe. And there were questions about whether they were going to make it. Thankfully, they had a pretty warm winter. And I think some of the gas flows were a little bit better than people expected. I'm not an expert on that, but I see that there is one here now named Honest. So I'll just turn it over to him.
Dr. Anas, what a pleasure to have you join us. We'd be very much interested to hear your thoughts on what's happening overall and what the impact is going to be on the energy markets.
Thank you very much. Hello, everyone. Do you hear me well?
Yes, we do.
All right. Thank you. Thank you. On Saturday morning, we posted a note basically on the events, and our conclusion was the impact on the oil market is very limited. However, when the market opens, we are going to see some uptick in prices. And we mentioned watch Egypt. Watch Egypt. It's not Iran. It's not Israel, not Hamas. It's Egypt when it comes to the energy issues. Then we had the leak yesterday to the Wall Street Journal, and people did not really pay attention to, and very few people basically understand this. The leak basically that Iran is all over this, and Iran basically helped Hamas organize the attack, etc. And then prices went up by about 5%. And we sent another note this morning basically saying that prices will fade away, and people did not pay attention to the leak. The leak basically came from a Lebanese source, and no one believes a Lebanese source. So that was a big mistake on those who believed that source, and probably the Wall Street Journal was kind of they really kind of did not probably vet that source. There are several issues here. The first one is everyone knows who knows about the politics of the area that Iran is involved with Hamas for a very long time. So it is the first thing. It's not a big news that Iran is involved. But the issues here and that's what we wrote in the note this morning. We have to pay attention to the issues here. No one has an interest in the escalation. And the Biden administration in particular, because Biden, when he was a candidate, he ran on a platform. Part of that platform is to reinstate Jacoba or the nuclear deal with Iran. And now basically to start to say that Israel is going to hit and the Biden administration is going to punish Iran and they are going to impose sanctions and they are going to kind of make sure that they are not going to export any oil, etc. That goes against everything the Biden administration stands for. The second, of course, there are many issues, but I don't want to take a lot of time on this. We have to pay attention that any reduction in Iran exports means more dependence on Russia. So you have choice, Putin or the Iranians. And it is a very hard choice. It is not in the interest of the Saudis or anyone else to go for escalation. It's not in the interest of Iranians to go for escalation. This question comes up all the time about the Iranians basically closing the Hormuz Strait. This has been going on for years and years. The Iranians cannot close the Hormuz Strait. It's very wide. They can cause problems, but they cannot close it. The issue that people must understand is that most of Hormuz Straits are Omani waters. They are not Iranian waters. And therefore, if they close the Hormuz Strait, they have to occupy Oman. That's what it is. They will occupy Omani waters. And if they occupy Omani waters, then the GCC, which is the 6 countries, they have a defense pact from 1982 that's still valid, which means that all of them will be involved in this trying to defend Oman. So the issue that the government of Iran will do crazy things, etc., that's complete nonsense. There is no reason for worrying about any of the problems. Now, the only thing we got to worry about is that we have supporters of Iran who are loose groups in Iraq or Lebanon or Yemen or other places. They might act on their own. And this is the problem we've been having. Historically, when we talk about the oil weapon, we know the actors and we know their objectives. And mostly they are state actors. And we know whether they impose an embargo or do anything else. We know who they are. If you go back to World War II, we know who attacked the ships, the oil tankers, and we know why. Now, with the advancement of technology, the problem is many non-state actors are involved, even gang members. And it is in a very kind of limited or small budget. They can wreak havoc on the oil industry. Just a couple of small drones, they can cause problems. So if we might end up with some of those kind of crazy guys doing this because they are supporters of Hamas or supporters of Iran. But to have it on scale of governments, that's not going to happen. It is the interest of the Biden administration to calm everything down. It is in the interest of the Iranian government to calm everything down. It is in the interest of the Saudis to calm everything down. The final point is regarding what was published. The Wall Street Journal basically been publishing crazy articles about the oil market since for the last 2 years. And we know, for those who are involved, we know what those articles are, what they meant, and how wrong they were. But the issue here is there was another article being published saying that the Saudis are offering the Biden administration in exchange for an arm peace pact, etc., nuclear, and they will increase production and lower prices. This is another nonsense. The Saudis basically they've been trying to isolate oil from any negotiations, even when the president of China visits Saudi Arabia, they refuse to negotiate oil. Oil is out of the picture completely in any of those negotiations. And what they would say in any meeting is, we will always try to meet demand. So someone in the Biden administration or the other side might take that point and say, oh, they are going to increase production because they are going to meet demand, and demand is growing, therefore there will be increase in production. Prices will decline. That's completely nonsense. So that's kind of a sum up of the situation right now in terms of geopolitics. In terms of market fundamentals, it is very clear if we stay in the 80s, this is supported by market fundamentals, and it is good for everyone. The problem is with the rising dollar, the situation might change. And again, I will end with this: watch Egypt, because what happened is when we told our readers to watch Egypt, Israel this morning closed the Tamar gas field because of the events. And the Tamar gas field export gas to Egypt, where it is liquefied and then re-exported to Europe. Egypt stopped exporting LNG a few months ago, and they are supposed to export LNG at the end of this week. Now there is no gas from Tamar, no LNG for Europe. That's one. The other issue is the IMF came up with a report, and it is very clear that the Egyptian pound is going to be depreciated, and that's a crisis for the Egyptians. So between the gas issues and between other issues related to currency, economy, etc., and all the events we see, the Arab Street is boiling anyway throughout. So keep an eye on Egypt. Back to you.
Thank you for that, Dr. Anas. If there are any other questions from the panelists, feel free to chime in. I do have one question, though, which is the events that unfolded over the weekend, we're all scrambling for the narrative, the explanation. We look at the scope and the scale of the Hamas operation, and we think, why now? Why the timing? And why is this so different from what we've seen in the past? It does feel like an escalation of sorts, and we're grasping at narratives as to what are the underlying motivations, who are the state actors, and so forth. What is your kind of interpretation of the Hamas actions over the weekend? What are the objectives that are trying to be achieved?
I am definitely not the right person to answer this question, but I can tell you two pieces of information, which we stated in the Saturday note, that look what happened the day before, or 2 days before. 2 days before the event, we have the attack on the military base during graduation of the cadets in Homs in Syria. Hundreds of people basically got killed in that. And we don't know who did that. So this is just 2 days before this event. At the same time, we have an attack by the Kurds on a military base in Turkey. Then Turkey responded with drones, and the US downed one of the drones. We cannot look at those events in isolation. So there is something. But what's striking, and this could be pure coincidence, but we got to be very careful inferring things from it. But it's really intriguing to look at the data. And this is kind of really strange. Israel used to depend heavily on imports from Kurdistan, oil imports. So the northern Iraq basically will export the oil to Jihan port in Turkey through a pipeline. And as you know, since March, that pipeline being shut down, and we lost about 450,000 barrels a day. So Israel was left stranded. Strangely enough, it is very clear that the Israelis have no idea that they will be cut off. So you want to talk about intelligence failure or information? So this one. So what Israel did basically is they switched to Gabon, and they started importing from Gabon. And they woke up one morning, and there is a military coup, and they lost the oil from Gabon. Another failure of intelligence. Strangely enough, before the coup, 3 weeks before the coup in Gabon, China, who's been importing oil from Gabon for years, they stopped importing oil from Gabon. And strangely enough, China stopped importing oil directly from Iran 2 weeks ago. Just kind of an observation. We don't know what it means, but it's kind of very strange coincidence to see all of these things happening. Back to you.
Weimar, you have your hand up. You have a question for Dr. Anas?
Yeah. I was going to go back to Iran and the Strait of Hormuz, and just something I remember, and I could be wrong in this assertion, but when some sea mines got loose in the Black Sea, didn't that cripple shipping there for some period of time because people wouldn't insure the cargoes there? Like, what if somebody just let sea mines loose in that area?
We have a long history of this in there. During the war between Iraq and Iran, there were all kind of mines and there were all kind of incidents, and insurance rates went through the roof. And guess what? Some countries like Kuwait literally had a contract with the U.S. Navy to protect the ships. So every ship basically will have the U.S. Navy escorting it. So the cost was the cost of insurance and the cost of defense. So you don't have to go even to the Black Sea. It happened in the Gulf itself, in the same area.
Isabel Court.
And this is a very fair.
Did you mean?
This is a very fair assumption that we might end up with something there. I remember we have several incidents happened there. We have the 4 ships that been attacked at Fujairah port. Some of them were oil tankers. Not too long ago, the day remember there was a prime minister in Japan called Fujimori. The moment he landed at Tehran airport, the attack happened, and 3 of those ships were related to Japan in one way or the other. So things that area, many things could happen. Back to you.
Thank you for that. How long do you anticipate that this conflict will? I mean, it's hard to obviously guess how long it'll go, but based on kind of the if I guess another way to put that is if Iran is disavowing or trying to distance itself from this conflict, about how long do you think this conflict will last, and do you see it largely being confined to the Levant region at this point?
Um, I I really don't know. I cannot answer this question. I mean, if you just look at the history, these conflicts did not last long, so it matters of maximum weeks. But we don't know. A lot of things changed relative to the history. That's number one. The other issue is we have a serious problem with the media reporting the conflict as conflict in the Middle East. This is an old problem. There will be like a couple of attacks on the southern Lebanese borders, and all of a sudden the headline is war in the Middle East or conflict in the Middle East, while they represent a very, very small percentage of land and people in that area. Because the problem is in North America and Europe, when you talk about the Middle East, it is associated with oil. So we need the media to be very clear to specify it is literally a war between Hamas and Israel, or a war between Gaza and Israel, and avoid talking it's a war in the Middle East. That's really a big problem, and that's why prices went up in the early hours of trading, simply because people panicked because the media was talking about war in the Middle East. Back to you.
Well, thank you again for that. And it's interesting to kind of see the market reactions to this point, that they're basically fading the fear that this is going to emerge into a much wider conflict involving multiple state actors. But it'll be curious to see how this plays out over the next several days. Weimar, you have another question?
Yeah, I was wondering if Dr. Anas could opine a bit on the nat gas situation, because that's something I've been increasingly long in what I'm seeing with demand and some of the shortfalls that are starting to appear around the world. I mean, you're starting to see the price of gas finally move up.
Sure.
I was wondering if you could talk about, especially Europe, what's going on there, the import situation. They closed down 3 nukes in Germany finally, and then they obviously have that field in Holland that I mentioned
Okay.
closed.
This morning, we released a note regarding the conflict in between Hamas and Israel. Later today, we are going to release another note on the proposal by ExxonMobil to buy Pioneer. Probably we'll release it this evening. And then we have another long report. This is a monthly report. It's a gas tracker for the EU. So that report is ready, but we are not going, we are going to delay its publication simply because of the conflict. So the issue here is we are seeing more dependence on Russia. And this is one of the issues that goes against, again, I mentioned earlier, the idea that the Biden administration will go for a wider conflict, because it literally means the practical end of the sanctions on Russia. Because you need a substitute. Where the substitute is going to come from? Don't expect the Saudis to increase production. So people will revert to Russian crude in one way or the other. We've seen it in gas. Now, there are no sanctions on gas, as you know, but dependence on Russian gas has been increasing. If this winter is going to be severe, dependence on Russia is going to be even higher in this case. But what we are seeing here is everyone is playing a game. And this game, we warned about this game like 3-4 years ago, but we did not kind of focus on it big time at that time, and probably people did not believe it. This idea of moving away from long-term contracts for LNG to spot market really need more attention from researchers, because it is causing a lot of problems in the market and a lot of confusion. If you look at how the Russians played the game, the Russians literally cut off Europe. Literally. Putin they said, you pay me in ruble, otherwise I'm not going to send the gas to you. We woke up the second day and say, okay, you want to buy LNG, I will sell the LNG for you in anything you want, in any currency you want. So they switched from piped gas to LNG. Why? Because the piped gas was sold at long-term contracts, and long-term contracts basically were associated with oil prices. At the same time, as you know, gas prices at that time were going through the roof, like 70 something. So the Russians basically literally switched from the cheap gas to the expensive gas, and they were making money, and Europe was buying it. And if you look at the strategy of the Russians right now, the Russians are going literally LNG. They want to finish those pipelines to China, and everything else in the future is going to be LNG. Why? Because they can sell it anywhere in the world. But what we see in the coming months is, as you know, there's just the common sense that everyone knows. It is about the end of the hurricane season in the Gulf of Mexico, and it's about how severe the winter is going to be. If Europe got lucky with no severe hurricanes in the Gulf of Mexico, just like last year, and no severe winter, just like last year, there will be no problems this winter. But the problem will always exist. There is no replacement for Russian gas. Right now, the dependence of Europe on natural gas, 40% United States, 20% Russia. So 60%. You add Norway, another, I forgot what, 18% or something like this. So that's another problem from a national security point of view and from energy security point of view. Europe is dependent on 3 countries. Any problem in any of them due to weather or any other problems, even labor strike, as we've seen with Australia, they are in trouble. And let's face it, Europeans are having serious problem because they are not providing real solutions to their problems. They just shifted dependence from one country to another. Back to you.
Dr. Anas, I'm sorry, this is Mike Green. First of all, your commentary was fantastic. Thank you very much for sharing it. When you think about this question of, properly defining the Middle East, properly defining the constraints of the national actors, etc., one of the things that you highlighted is the risk of individual actions. And, this is one of the analogies I think I've drawn to try to make people aware of how the behavior of state actors can actually be bound by the behavior of individual actors. Very famously, World War I with Gavia Princip and the attacks on the Archduke Franz Ferdinand was not a state actor, but ultimately a apology and the turning over by Serbian authorities was not able to be accomplished and treated as an action of the state. Are there similar risks that you look at here?
Luckily, no, for simple reasons. Because those countries went through this before. I'll give you the biggest example, Saudi Arabia and Al Qaeda during September 11th, terrorist attacks. We have 19 Saudis basically who made the attack, and they tried to drag Saudi Arabia and the Saudi government into it, but everyone was aware that they are different, and the Saudi government basically completely kind of disconnected itself from it. There were several Saudi actors who tried to do things in recent years, and the Saudi government was aware of it, and through their diplomatic channels and others, made others aware of these things. So I think the Middle Eastern governments in particular are aware of not being dragged into it by individual actors. And in some cases, they are against those individual actors. And if you look around, basically, you look at the people who are the political prisoners who are in jail in several countries, it fits this narrative that they are trying to prevent individual actors from dragging the whole government or the whole country into these things. The issue here is on the other side. The other side basically is if you end up with another September 11th, will people forgive the government where those guys come from? Will they believe it? Well, so we have some issues that are related to this, but for the government themselves in the Middle East, it's very hard to see them being dragged into what you see because the Arab observers on TV, they are already been saying this for the last couple of days. They're saying that we don't want Hamas to drag us into their war.
So in that context, and first of all, again, very, very helpful. In that context, you would not overinterpret the language released by the Saudis of, the Israeli occupiers, etc. I mean, from your perspective, that is diplomatic speak that has to be made in the context of being an Arab nation and a conflict that involves Israel. Is that
Yes,
okay?
yes, but there is more. There is more to the story
Okay.
because if you talk to the Saudi officials and others, even Kuwait, Qatar, and everyone else, Qatar and the UAE have relationships with Israel. And if you talk to the officials, what they say is exactly how the UN views the situation. So they go along with the UN. It's not an Arab stand. They look at it as a UN stand. Here is an occupied land, and here is Israel. So if you look at all their language, aside from feeding the streets to calm it down, they are following the UN lines. So
Got it. I
it's
think
not a
it's a
big deal
really
either way.
important thing for people to understand. Yeah, no, I think that's a lot of the language that we've seen. And again, I think you did a good job taking to task the American press. And I would suggest that the American press should be taken to task across multiple angles on this dynamic. But one of the angles that they have been hitting is, this use of language from Saudi stands in the way of any form of normalization, sets back treaties, etc. I'm not sure I agree with that statement. This feels so far like the markets are doing the right thing and saying we need to figure out how contained this ultimately is before we react in any meaningful way.
Yes, and there is one more observation I would like to mention here along the lines you mentioned, Michael,
Yep.
that the Islamic scholars issued what they call fatwa or religious decrees. The religious decrees basically regarding the conflict. They sided, of course, with the Palestinians, etc., etc., etc. And some people are circulating them on WhatsApp and social media and say, look, what the Muslims are, what the Islamic scholars are saying, and therefore there will be crises and killings and this stuff. They've been issuing those fatwas for the last 70 years. There are hundreds, probably thousands of them. So what is circulated today be repeated so many times in the last 70 years. So it's not a big deal.
Yeah, I think that's a really important point because the vast majority of time our attention is distracted from the texts that are being released. On a normal Monday, we don't pay an awful lot of attention to what is being said by an Iranian cleric. When we suddenly turn and start reading it, we kind of need to consider everything that they've said up to that point, and is there something truly unique and different being said? Let me ask you just a related question on the same front, which is when you mention the state actors and the governments, how much, and I think you did a really good job on that. The one question I think that a lot of people have is the relative disarray of Israeli politics and the potential for the use of this for political means internal to Israel. Does that raise the risk of a response turn, to treat as the normal cost of doing business in the region?
Couple of points here. The first one is what we saw basically fits the historical trends. The only difference right now is the scale. That's the only difference. But it fits
Yes.
in terms of narrative, it's still the same narrative. So there is no more than what we already heard in recent years. It's just the scale now is different. The other related issue is how, and I think that the Biden administration is really in deep trouble right now because they were trying to appease the Iranians since Biden came to the White House, trying to get them into a deal, and the Iranians basically are refusing. And strangely enough, I am, as a researcher, mentioned this in 2018, and it is on Twitter for everyone to see. I mentioned, look, once Trump basically end this deal, the Iranians are not going to accept but more concessions from the United States. So it was very clear that the Iranians are not going to accept it, because if every president is going to change policy, why I have to be involved in it? So the big issue that will remain, the conflict in Gaza is going to end. But the issue that will remain for the Biden administration is how to deal with Iran. Ironically, in 2005, I wrote an article, again, it is on Twitter and the web, and people can see it, okay? I said, Iranian nuclear program, the never-ending crisis. The never-ending. And it's been proven to be right time after time after time after time. So the issue of Iran is going to remain even if the Gaza conflict is going to end.
Is there anything that would cause you to change your mind on that?
Short of
The
regime
fear,
change, Mike?
Well,
again,
that's why I'm asking the question. Like, I think it's a fascinating observation.
now the issue of those individual actors versus state actors, it works on both sides.
Yeah.
I mean, remember who assassinated the Israeli prime minister before?
Right, Sharon. Yeah.
Right? Not Sharon.
Perez. I'm
Rabin.
sorry.
Rabin.
Yeah, Rabin. Yeah.
Rabin.
So the issue is those individual actors can work on this idea works on both sides.
Yeah, it's an interesting stasis that you're highlighting. Effectively, the state can't change because the individual actors can't change, and if the individual actors were to rise to control of the state, there'd be resistance in an opposite direction. I think it's an accurate assessment. It's why these things tend to persist as long as they do. Can I ask you a related question as you talk about the luck of
You're
Europe?
cutting off,
Right?
Mike.
I apologize. Yeah, I'm in transit. So let me see if I can do a better job here. Give me 1 second. Okay, can you hear me now?
Yes,
Okay,
we can.
perfect. So, you mentioned the
Okay, Michael, I did not hear you.
So you mentioned the good luck that Europe had with the warmth in.
Raul, do you guys hear me? Probably I am the one who's out.
We hear you,
Yeah,
We can hear everyone. Yes.
we can hear everyone. And
Okay.
I cannot hear Michael.
Okay, Ben, I'm going to disconnect, but if you can ask Anas the question that I ask you, which is...
Okay, what I'm going to do is I'm going to exit and come back.
All right. So I'll keep talking, and we'll see if the problem is on his side.
Yeah, Mike, you keep going and let Doctor come back.
So the question that I was going to ask the doctor is this dynamic of good luck versus bad luck, right? So the flip side, of course, of fears of global warming is the fact that we have warmer winters, right? Is there an element of the reverse of that? Because we actually had a relatively cold summer where we needed less air conditioning in many of the regions I saw. And then, of course, that flipped around the opposite direction. So, you know, the question I guess I would ask is, how do we think about how much of this is luck? How much do we think this is just the system is more robust than we actually think, right? I mean, the very obvious one being
Germans can turn the temperature down another 1 degree and use significantly less energy for a wide variety of reasons, by the way, right? So, I mean, just mechanically, if you think about trying to keep the temperature at 70 degrees versus 68 degrees, when it's 55 degrees outside, it's harder and requires significantly more energy to do it at 70 because you're establishing a temperature differential that needs to be maintained. If you decide to go at 68 or 67, right, nobody's going to die, right? We're just going to be living in reduced comfort levels versus where we were 3 years ago. Is the system ultimately much more robust than we are giving it credit for? That's the question I would ask Anas. Because it's not clear to me how much of it was luck and how much of it was there's a lot more spare.
I think we can mathematically sort this out without any problems,
Okay.
because all we got to do basically is look at the temperatures, look at the weather, etc. But you are right, when you are within a close range, you are right, this will happen. But we have to remember two things here. With severe weather, you don't want to mess with it, period, under any circumstances in any country. All the evidence from all around the world shows that when you have a severe winter, severe weather, you cannot play with that. And the fact is, last year, and this is a fact, that the number of people who died from the energy crisis in Europe is higher than the number of people who died from COVID during the same winter, or the number of Ukrainians who died from the war during the same winter. So the impact was there for the energy crisis last year, and that's a mild winter.
Yeah.
So if it is severe, no one wants to gamble with that. Period. Yes, they got lucky with the weather, whether the hurricanes or the winter, because the 40% that comes from the United States all comes from the Gulf of Mexico, where the
Yep.
hurricanes are.
Yep.
So we might end up with just 1 year, with destructive hurricanes and a bad winter back to back, and you will see disaster all over. Back to you.
Yeah, I've got nothing else on that. I think that's a fantastic. Every part of what you just said, I think, is a really important and interesting observation. I do think that we tend, we tend to catastrophize things, just like the media does, for the very obvious reason that it's more quote unquote fun and more exciting to talk about. The world tends to muddle its way through, but we are very much skating. We're swinging on a trapeze without a net. Is definitely the point that I think is important to consider. Doesn't mean we fall. That's the caveat to all of it.
Thank you, Michael. Weimar, I think your hand was up earlier.
Yeah, and Rahul, I got to step off now for my podcast, but thanks for inviting me to co-host.
Feel free to come back, Ben. Thanks, Ben. Go ahead, Weimar.
Yeah, I was just going to ask too about. I know one dynamic that got introduced to the European market last year was the growth of these floating import facilities for LNG, sort of able to set up temporary connections to the German.
I can't hear. Is he speaking?
Yes,
I can hear him.
Doctor. Okay, Weimar, do you want to hop down and come back up? I'm not sure what's happening. David, in the meantime, if you'd like to jump in. Okay, I'll wait for David and Weimar. In the meantime, Doctor, I had a question. As we all try to navigate, whatever information we're presented, again, no geopolitical expert by any means, but I think many are curious on what to continue to look at or watch that can present any sort of indication of what could happen, any data points, any news sources you're looking at. Just kind of curious if there's anything folks can look at or read into just to kind of educate ourselves more.
What market?
Oil, and just overall on this crisis. There's probably a lot of misinformation. So I'm not sure if there's anything you can share with the audience on things they can read or just kind of find the right place to view this information.
Yes, I just want to, there are few, but I just want to build on the Tamar field, the Tamar gas field closure
Go
this
ahead.
morning. As you know, Israel and the countries in the area, the Eastern Mediterranean, were trying to promote themselves as a substitute for Russian gas. And the Israelis were pushing really hard for a pipeline. If there is a lasting impact to this incident today, it is the destruction of this idea that this pipeline is going to be safe and they are a replacement for Russia. So let's keep that in mind. So this is one of the lasting impact of this. And therefore, if you want to dig deeper and come up with a conspiracy theory and say, well, Putin basically is trying to destroy this idea, well, probably he succeeded. That's number one. Number two, again, watch Egypt for several reasons. Number three, those who follow me and been kind of tired of me talking about the Chinese SPR and the Chinese inventories. The fact is, the Chinese are using their inventories. They are already using them. They already released oil from the SPR. And it is always the time they release when prices are between 70 and 75 and above. So they already released over 50 million barrels. We expect them to release another 35 to 40 million barrels until the end of the year. So the idea here is, even if things get nasty, even if things get more bullish for oil because of geopolitics, etc., it's not the Saudis who are going to react. For the Saudis, the Saudis' idea is very simple. We don't react to speculation and we don't react to political premiums. Who is going to react? China. China is going to react to both, and they are going to release more oil. China still has more oil in inventories today than the United States. So they can release more and more if needed. And therefore, for oil prices to go way higher because of geopolitical events, China is going to cap that. The last point is related to the Russian gas. Russia wants to sell more LNG to Europe. EU leadership, not the countries, the EU leadership is trying to ban LNG from Russia. The problem is, where is the substitute? It's funny because when you do the math, the only substitute are Russian piped gas. It's crazy. Back to you.
Thank you, Doctor. Waymar, are you back?
Yeah, I'm back, and this kind of relates to the doctor's last point. But before I say that, I just wanted to point out one funny tidbit on the conspiracy angle. October 7th, when this whole thing started, was actually Vladimir Putin's birthday. I know it's also a day after the Yom Kippur War in '73 and all that, so there's a lot of interesting date stuff going on with this. I don't think that, but it is kind of ironic. It's almost like a gift to Putin. But the other thing I wanted to bring up to Dr. Anas was the floating import capacity in Germany. I know that was something that was kind of a big issue late last year for when they were going to make it through the winter. And there was this rush to try to complete the kind of fixed import terminals that are used to traditionally import LNG. But in the meantime, they had set up these temporary, like ship-based import facilities to get the gas right into the local German pipeline system. Has that been expanded over like the intervening 12 months at all? And if so, by how much?
Well, they focus on LNG. The problem we are having with the Germans is this. At what price? I mean, we always hear about the supplies and they try to ignore the cost. At what price? The Germans are behaving in a very strange way when it comes to their gas supplies. If you look at all their negotiations with Qatar, first they negotiated with Qatar about Golden Pass in the United States. Although the negotiations were with Qatar, it was about US shale and US gas and US LNG because Qatar owns Golden Pass with, I think, with Exxon. That negotiations failed because the Germans refused to sign a long-term contract. And then they had another set of negotiations regarding the new project or the new expansion in Qatar. And again, they refused to sign a long-term contract. Then they built those temporary stations, etc. And they still think oh, this contradicts our climate change policies, therefore, this is a fossil fuel, we don't need it in the future. They just started just last week. They started or give permission to two power companies to restart coal plants. So the level of confusion that they have about what they want to do is causing all kind of confusion in the market about the future of natural gas and whether there will be demand or the LNG, whether this is going to be they are going to revert to long term, etc. Luckily, there is a new development in the LNG market today, which I think it's just amazing development, which is the medium term contract. I think the Qataris nailed it on this one, and probably they will offer it to Germany and others for the remaining capacity of the projects they have. That okay, don't sign 30-year contract. What about, let's say, 7, 8 years or 10 years? And I think that will solve the problem of several countries. Back to you.
Robbie, go ahead.
Thank you so much, Rahul. So I have a question, Dr. Anas, which is very linked to the war situation, and we've been really looking at all different dimensions in India. But I think one particular dimension that I've been really interested to really explore is the role of China, and also the role of China, especially that G20 really came up with this very important alternate route, right, which is the Indian Middle East Europe Economic Corridor. And we know that through the Abraham Accord, we were looking at possibility of Saudi playing a critical role in bringing peace. And of course, that's history right now, because as you said, if that is the conspiracy theory, they've been very successful in terms of China, Qataris, and the rest. So, what is your take on it? Because we are looking at just not a war right now. We're looking at a complete geopolitics shift, and also before G20, the world was divided. I think now after October 7th, the world is going to be even further more fragmented. So, what does it really mean for the looming recession, and where will this really take? As we always know, energy is the most critical piece, and energy crisis due to Ukraine war. Will this really change many things in terms of some of the positive things and signs that we were seeing? So, what is your advice and speculation and prediction? Thank you. Rahul, was I clear, or you were not able to hear me?
Yeah,
I heard you,
I heard you.
doctor.
Sorry. This idea, I can answer some of your questions, but not all of them, simply because I don't know the answers. But this idea of the corridor, I think some of the media, especially in India and some in the Arab world, misunderstood the whole issue completely. Who came up with the idea and who imposed it and why people agreed to it? It has nothing to do with the Arab world completely. This came from outside. This came from the Biden administration and others. And if you look at that corridor and the details of it, the only thing we can see is probably we can end up with a grid connection, some internet and some cables, and that's it. And the reason why, because it's so easy and cheap to load a ship with whatever you want out of India, take it through the Suez Canal, and take it to Europe. That's the cheapest way. Why you have to take a ship to Ras Tanura or any other port in Saudi Arabia, unload it, and then you will have thousands of trucks trucking it to Jordan and then transferring it to Jordanian trucks that goes to Israel, transferring it again to Israeli truckers to take it to the port to load it to a ship and take it to Europe. If you look at the cost, no one will accept that. No one will adopt that. So this is kind of a fake idea being sold to the public that will never materialize. The grid connection, a great idea. Cable connections, internet connections, great ideas. More than that, that's it. In terms of trade, whether the Saudis join BRICS or not, the trade with India and China and other countries is set in stone. Why you sign an agreement on paper and all of a sudden tomorrow you have a different trade routes and different shapes? You are already maxed out anyway. So the idea out of the G7 meeting in New Delhi, basically, of this corridor has a lot of nonsense, and some media outlets basically took it farther, and we should look at it in a practical way. People thought this is a substitute for China, alternatives, etc. It does not fit. It does not fit at all. And I might change my mind if I see a railroad connecting two Arab countries together. If this happened, I might change my mind. There are nothing. If you look at all the Arab cooperation for the last 50 years on any of the projects, even the pipelines were bombed. All those projects basically failed. The only projects that succeeded, the cooperative projects that succeeded in the Arab world, are the projects that serve the Arab consumer, such as the Arabsat satellites or other things that are related to this. Other than that, everything related to projects related to exports, all of them failed. All of them. Back to you.
Thank you, Doctor. David, go ahead. Okay, looks like David is sleeping. Hey, Krunal, how's it going?
I am not hearing anything. I don't know if someone is speaking.
Go ahead, Wayne.
Yeah, since no one's talking, I'll ask you another question. So I just posted this, but there's a story about Maduro doing some saber rattling with Guyana now, which is kind of an interesting development in my mind, given how that region of the world typically doesn't see neighbors invading each other and stuff. But what do you think of that situation? Is there any potential for that to spiral?
I put a tweet on Guyana about a month to see the number of Venezuelans showing maps that half of Guyana basically belongs to Venezuela. I never even expected that. The whole issue was about Guyana and its oil and investment, etc. I never expected the number of Venezuelans with the nationalistic attitude saying that this is basically part of it, and all the gold mines, etc., belong to Venezuela. They don't belong to Guyana. So I was surprised at the nationalistic instincts of those people, which indicate that the issues are really deep. And one of the historic examples that we should worry about is that if you study history, leaders always try to create an outside problem when they are in deep trouble inside their own country. If the Europeans have done it, they invaded other countries, they invaded the Middle East, etc., when they have domestic problems. So do they have, in a sense, are they trying to divert attention and rally the public around the flag instead of having a divided country? All that is possible. How the U.S. will react to that, given that U.S. oil majors basically are heavily involved. And my issue is how the leaders of Guyana will react to all of this, because my fear is that once everything become nationalistic, they become nationalistic, and as a result, they might end up nationalizing the oil companies. I don't know much about the details of the conflict itself. I learned about it from Twitter about a month ago about the how the Venezuelans feel about the Guyana part, that they think it's part of Venezuela. Back to you.
I see we have Philip. Did you have a question? Go ahead,
All
Wyman.
right, well, I'll just keep peppering him with questions. So another thing I've been tracking a little bit is the growth of ships that actually run on LNG. And I was looking through some trade press last week, and it looked like close to 1,000 large ships, like tankers and cruise ships, are now capable of running on LNG. And it got me to thinking if there's now a relationship, given kind of the issues with diesel, between switching to that LNG fuel when something like diesel or bunker fuel, which is similar-ish, goes a lot higher. Could you give us some of your thoughts there about sort of what's been changing?
Yes. Basically, the issues right now is no longer between diesel and LNG. The issue is about methanol versus LNG. And it is very clear that based on the regulations, especially of the European Union and several ports in the European Union, LNG is more suitable than methanol, despite the fact that there are some advantages to methanol. All of this started with, as you know, the IMO 2020. IMO 2020, basically, they wanted shippers to use low sulfur fuel. And the problem with low sulfur fuel, basically, is not only it's expensive, it is volatile in terms of the market. And you might end up with situations where some ports probably even out of it. So that's scary for some of the shippers. At the same time, those big shipping companies, just like the trucking industry in the United States, the trucking industry in the United States, they wanted to have few electric trucks, despite the fact that their cost is extremely high, simply because they can balance their CO2 budget, where they can look kind of acceptable. And the shipping companies are doing the same. And luckily for several ports around the world, they are able to deal with small scale LNG. So that can solve the problem. Right now, with the new technologies where we can have small scale and floating LNG, the issue becomes easier. The other related issue related to that natural gas, if you look at the numbers, we have plenty of natural gas around the world relative to oil, at least in terms of what we can extract. So if you want to look at the next 20 years or 30 years, we have more availability of natural gas than oil. And it just happened that when you talk about natural gas, it's mostly out of OPEC and OPEC countries. Even Qatar, as you know, got out of OPEC. And therefore, it exists in non-OPEC countries, and they view that as something good. Back to you.
Philip or Data Shortcut, did you guys have a question, comment?
I was just trying to add some stuff up top when it came to some of your topics that you were discussing, Rahul. So when it came to the pipelines that Dr. Anas was even speaking of, on top of, I think he'd also stated that this could also potentially have effects with other countries like Iran. So the Bloomberg as well as the Journal had some pieces on this over the weekend. Right. So I don't know if Dr. Anas wanted to comment potentially on the Iranian exposure, or if he already has commented. Just ignore that request or question.
Can you have a specific question? Because I did not get what the question is.
No problem, sir. Okay, so the question was, obviously that region is instrumental when it comes to how it has an import and export capacity, especially on the export side in the Strait of Hormuz. So with the instability, obviously it's not on that side, but the Suez Canal still does serve as an important gateway. Would you have an opinion on the fact of Iran or Iranian exports being affected by what's going on right now?
Did you hear the question, Doctor?
Yeah, so if you want me to repeat it again, Rahul, I
No, no,
will.
sorry. I did not notice that the microphone was off.
Okay, no, no
Um,
problem.
yeah, thank you. When it comes to the Suez Canal, we have to remember the following: that the Suez Canal has its own force, different from the Egyptian army. So it has its own force that protect the canal. At the same time, nearby, other countries are protecting the canal too. But we have to go back to what Michael Green was talking about earlier, that still we fear individual actors basically causing serious problems in the canal. It's not going to be the governments being involved, it's really individual actors in this case. The capability of the canal, we've seen it when the Evergreen ship got stuck, if you remember. That was a big operation, it lasted a few days. But if you look at the other ships, over time, they were able to float those ships within hours. So they have very strong capabilities of solving those problems in the canal. The other issue is because the Suez Canal Authority is completely independent with its own army, and all the factions in Egypt understand that the one of the main sources of income is the Suez Canal. They don't want to repeat the past because the past was very costly when they closed the canal. So we've seen it in the events of 2011, 2012, when they literally sidelined the canal. So the canal was operating normally while the country was boiling and we have change of government, etc., and the canal was not affected. This is the new norm for it because every faction, whoever is going to be a leader in Egypt, wants the money out of the canal. So why kill that cow, the cash cow, by doing something to it? Therefore, if there is anything is going to happen, it will be individual actions in this case. We've seen on the other side, the Houthis basically causing problems on the other side of the Red Sea. And we've seen some ships basically being attacked. I would be worried more about that part than the Hormuz Strait or the Suez Canal. Back to you.
Thank you.
Noah, how's it going, man?
Yeah, it's going all right. Lots of volatility to start the week, which is always good. How are things on your side?
Not too bad, just discussing the markets here, and then we have Dr. Anas, so picking his brain on energy and all those sort of things as well. Any questions for Doctor? Feel free to jump in, Noah. Weimar, go ahead.
Well, I didn't have any questions right now. Sorry.
I know David has a few questions, but he's on a call.
I
David, let me.
have a question.
Go ahead.
Dr. Anas, really from like 25 years perspective and 30 year perspective. I do a lot of work on solar, green hydrogen, biofuel. I mean, I know that you're skeptical of it, but do you really see, because you yourself have tweeted some critical moments this year about the extreme weather. Of course, I'm not going to start advocating on climate change, but just from the energy next generation of energy sources point of view, where do you think, like, if we have to go beyond oil and gas in the next 25, 50-year perspective, what do you think should be the bet that we should get into? Green hydrogen, biofuels, solar, wind, tidal? What is your perspective? I'm looking completely from a future perspective.
Doctor, you there? Go ahead, Weimar.
Well, I don't want his question to go unanswered. I think Dr. Nas might be
Yes,
on mute.
yes. Sorry. Yeah, sorry.
Okay, go ahead, Doctor.
The first fact is the amount of oil used in OECD, China, and India in power generation is extremely limited and less than 1% of most of those countries. And therefore, even if you double, triple, quadruple, whatever amount you want to increase your capacity with, whether hydrogen, solar, wind, whatever, has a very, very limited impact on oil. So 20 years from now, 30 years from now, forget about it. It has very limited impact. Today, the demand for oil is about 102 million to 203 million barrels a day. How many barrels of that is used in power generation worldwide? Is less than 5%, mostly in the oil producing countries and poorer countries. How many barrels of that can be switched? OPEC think we can switch 1 million over the next 25 years or 20 years. And based on our analysis, we can switch up to 2 over the next 25 years, which is nothing. So let's forget about this idea that when it comes to renewables and that is it's not going to affect oil. The second fact is the demand for energy in total, worldwide, is going through the roof. It's been on a kind of like almost 45 line for a very long time, and it's going to stay like this. And this increase, now we might see a decline in countries in Europe. They are small with declining populations, but not for the world. Where is the problem here? The problem is when you look at India, China, Brazil, Argentina, and the Middle East, others, even Vietnam and neighboring countries, when your energy demand is going up and you are spending a lot of money on solar and wind, you are barely meeting the growth alone. While the Europeans think, oh, you have to replace fossil fuel. Well, I cannot replace fossil fuel. There is no way I can replace fossil fuel because I'm barely meeting the growth. And therefore, the demand for fossil fuel basically is going to remain. We were able in the United States to reduce the amount of coal used simply because of the shale revolution and the massive amount of gas we have. But other countries do not have a shale revolution. So between those two facts, you can see where the problem is. Now, it comes to cars. When it comes to cars, for hydrogen cars, I've been an advocate for hydrogen vehicles since the 90s. And for those who follow my research, I already have work from the 90s on this. And at that time, my research was used in some big banks to finance or not to finance certain projects, because one of the predictions I made was that the oil industry is going to buy all those companies and all the technologies. And by the way, they did. They bought all those technologies and they switched it from green hydrogen to natural gas. Now, the whole point that you are working on green hydrogen, the whole point is we have wasted energy at certain times of the day from wind and solar and probably others. And the idea here is we need storage. Storage is costly. And if you use batteries, okay, you store it. A few days later, a couple of weeks later, you lose that energy in the battery. But if you store it in hydrogen, that will stay for a long time. So that's what the beauty of a green hydrogen is. You've got to look at it as storage rather than fuel, and that solves many of the problems. Back to you.
Thank you, Doctor. Go ahead, Wyman.
Yeah, so I think I've asked you a similar question like this before in a comment one time, but one of the things I've been noticing is a lot of, you're seeing this cited in the media, and then the EIA has their weekly figure, which I know you have a problem with. U.S. production is allegedly at or near all-time highs. And the rig count has been in decline for months and months and months. And it just doesn't seem to jive that right as the SPR releases, the last one that we did, the congressionally mandated one, ended, production seems to just start going parabolic thereafter. I think, though, that Rystad Energy is also reporting a similar number. So I was wondering if you could explain why U.S. production is so high when we've seen such little investment.
A long time ago, I was a student attending a conference, and I was sitting among several professors who were talking about why oil production continued to go up despite the fact that prices were low and a rig count basically was declining substantially. And that lesson basically stuck in my head until today. One of them said, do you know the number of stripper wells? They are above 50,000. So we drilled hundreds of thousands of wells over the last 10 years. that many of them right now are producing 20 to 40 barrels a day. They are in tens of thousands. And they'll produce because they make sense. So, from the whole argument, basically, people are forgetting this tale of the shale revolution, where we are left with massive number of wells that are producing small number of barrels, but when you multiply 20,000 by 10, you end up with a large number, or you multiply by 20 or 30. So this is one of the missing pieces of the puzzle, are the tail of all those wells that's been drilled in the last 10 years. So this is one. The other issue is about the productivity. Unless you get productivity numbers from the companies, every calculation is suspect. And suspect both ways, suspect on being on the downside or suspect being on the upper side. The problem with the EIA numbers, and that's why we created this hashtag crude quality matters, that they include a lot of NGLs. They include a lot of condensates. And for those who are listening, I need to explain this because we keep repeating this over and over again. The issue here is, if you look at the definition of NGLs, by definition, they are liquids that's been obtained from gas wells. And with conventional oil and gas, we had no problem for over 140 years. We had no problem with that. We have 3 buckets. We report oil, we report gas, and we report NGLs. And by definition, it comes from natural gas wells. With the shale revolution, things changed. We have NGLs coming from oil wells. So which bucket you put them in? You put them in the NGLs bucket, they don't fit because the definition says it has to be from natural gas wells. So the easiest way for the guys who work for the EIA was to add them as liquids to the oil pocket, to the crude pocket. And we ended up with those increases and those record numbers, etc., because most of the increase basically being in NGLs. Of course, the situation been changing for the last 3-4 months, where we are seeing more production of oil below 45 API. Back to you.
Go ahead, Rob.
No, very quickly, I think I just wanted to react to Dr. Nas. I think very good points on green hydrogen. Just wanted to let you know that I'm doing like an investor summit on 15th of November on looking at the opportunities on green growth and green hydrogen, green energy. I'll send you a DM, and anybody else, I'll just try to put that in the
So it
chat.
seems Twitter have a problem today. I'm not hearing anyone. Do you guys hear me?
Yeah, we can hear you, doctor. Can you hear me?
I don't think he can hear us, right?
I think maybe ask him to step down and come back up. Sometimes that helps.
I think probably DM him. Just for the other listeners, there'll be an event we're doing on green growth at the Indian Consulate. I'll be putting that in the chat here. If anybody's interested, get in touch with Rahul and me. I'll be in touch on that. Thanks.
Thank you, Ravi. Hey, Mike, if you're still around, any thoughts on the markets now that the morning sell-off has pretty much reversed and we're ticking back up?
Unfortunately, I kind of thought this would happen in our commentary at Tier 1. We noted that the odds of this actually hold on one sec. The odds of this turning into a real sell-off was far less dramatic than the headlines of war in the Middle East in terms of the impact on equity markets. And unfortunately, that seems to have played out, or fortunately, however you want to think about it.
Yeah, it seems pretty odd. But again, you have the bond markets closed today for Columbus Day, so see how that goes tomorrow.
The bond futures are open, right? And so bond futures.
What are the futures indicating, Michael?
I'm sitting here looking now, I feel like an idiot, but if I mean, we're looking at point. You know, the suggestion would, I mean, to me, there's a fairly significant impact on the bond market. So, like, I would look across the entire bond complex and point out the futures are very green across. So, if anything, this strikes me as perhaps opening people's eyes to some of the signs of, which is what I would expect on this type of event.
Thank you, Michael. We'll continue to monitor. Hey, doctor, I see you're back. Can you hear us?
I hear you now.
Okay, thank you. Weimar, did you have a question for doctor?
No, I think somebody else was asking him a question. It might have been Robbie. I'm not sure.
I think Robbie just said he was going to DM him something about
Yeah,
that event.
yeah. I just put that for folks. We're doing Dr. Nas. We're doing an event on green growth and green hydrogen opportunities in India, and I2U2. So I will DM you later, and if anybody else is interested, get in touch with me or Rahul. So I'll be more than happy to provide information.
Go ahead, Weimar.
Yeah, maybe this is outside your wheelhouse a little bit, Dr. Anas, but I suspect you know something about this. One of the theses I've been working under is falling long-term demand for U.S. Treasuries from some of the bigger foreign central banks, one of which would be Saudi Arabia, obviously, as well as UAE, Qatar, etc. And the reason for that is I've seen more and more of a trend towards, especially in Saudi Arabia, domestic investment, like sort of take the money that we make on oil and spend it domestically, reinvest in our own country, build out tourism as well as, mining and petrochemicals, all that sort of stuff. And I was wondering if you think that will be a long-term trend where maybe some of these oil and gas-rich powers continue to hold less U.S. Treasuries going forward.
If you look at the history of this, in the 70s, when oil prices went up substantially, and the Saudis and others basically ended up having a lot of money. At the same time, the dollar value was declining. We had a major depreciation of the dollar after floating it. At the same time, real interest rate was near zero. We have all kind of problems. OPEC met several times, and they formed a committee to study the pricing of oil. And they provided several alternatives to the US dollar. And they studied each one of them, including the use of the IMF SDR for pricing oil. This is pricing. I mean, you can pay in any currency. This is just for the pricing. Simply because they lost a lot of money since oil was priced in dollar and the dollar was depreciating. So they ended up with a serious problem. And when they were thinking about using different choices, the U.S. administration at that time talked to the Saudis and told them, okay, what are your fears? And told them, look, we have a lot of money and we are not getting real return on that. So the response was, okay, why you don't invest in treasuries and we guarantee a certain income and we guarantee the other fear, which is it will never be frozen. So whatever happens, treasuries, whatever investment for any country, it will not be frozen. So the Saudis, based on that, they have primitive economy, and the investment in other sectors everywhere else in the world basically was not a good choice. So they decided to put most of the money in treasuries. So putting this in mind, historically, the reduction as the economy expands The Saudis got more education than ever. They have experts in every field in finance, etc., etc. At the same time, they started that sovereign fund, the PIF, that is investing around the world. You look at it within that concept, it makes perfect sense to lower the amount of money in treasuries. So this is kind of a normal progression, if you want to look at it this way. Now, you might find some conspiracy theories to say, well, this. Yeah, there are several coincidences in life, etc. But from a historical perspective, it makes perfect sense because the historic numbers, the high historic numbers, excuse me, the high historic numbers happened simply because the Saudi economy was primitive and the other choices for investment were non-existent because of the inflation at that time, the depreciation of the dollar, etc. Now you have all those choices. Whether you are talking about investment domestically, internationally, whatever, even in electric vehicles. So I think that's the way to look at it.
I think another way to look at it is as a tool to manipulate the foreign exchange, right? Because if you're China or Japan and you think your currency is too strong against the dollar, how do you weaken your currency where you go out, sell your currency to buy dollars, to buy treasuries? So
Yes, but there is a counter argument. There is a counter argument. First of all, it does not fit the Saudis and similar countries because their currencies are pegged to the dollar. And for whatever the Chinese and others are doing, that's temporary. This is not a change in a sense. Like someone said, I forgot who was it the other day on one of the spaces. If you look at where the money is gone, it just moved from treasuries to Cayman Island or some other places, and they might return later on. But the idea here is for Saudi Arabia and other oil producing countries, their currencies are back to the dollar, so the theory does not fit. And for China and others, it is really temporary thing. Raul, I'm sorry I have to go, so I can take one more question if there is any.
well, what is the pegging mechanism? How do you keep it to a certain exchange rate? You have to buy dollars, right? Buy treasuries.
Well, they've been doing this for the last, 55 years, 60 years. Definitely there is a mechanism there. I don't know the details of it and how they did it. But I think definitely there could be the best way. If you are interested in this, search for for dissertations by Saudi students on this. If you have access to some search engines to search the dissertations, because I know there are several dissertations being made on that.
Thank you, Doctor. We'll continue talking the markets a bit while we're here. Of course, give Dr. Anas a quick follow, and if you enjoy these pieces,
Raul, do you
definitely.
hear me?
Yes, we hear you.
Yeah, so we can hear you on us if you didn't hear Rahul.
Okay. So let's take one more question and then I have to go. Sorry.
Go ahead, Wyman.
I don't have a question. Even I think Noah might have, or somebody else.
Noah, go ahead.
I guess on the hydrogen thing, what do you say to people that say, well,
Thank
to
you very
make
much.
hydrogen, you have to use, energy to produce the hydrogen, so it's
My
not
apologies,
like
guys. I
an
can't hear
efficient.
anything. Are people speaking? Okay.
Yeah, so right now Noah is asking a
Yes.
question about hydrogen.
Noah speaking right now, Michael. Can you hear?
I can't, but I'll listen quietly.
Go ahead, Noah.
I can hear him, so I will
Yeah.
answer him and then I will bail out. When it comes to energy, if you want to calculate the amount of energy used to the amount of energy produced, that's absolutely correct. We have no problem. The only issue is when it comes to finance, you have wasted electricity. Let's say after midnight, wind is blowing. We have a lot of wasted electricity, and some countries are selling it at negative prices. So yes, when you look at energy alone, you are correct. But when you look at the finance, it's a great opportunity. Back to you.
Thank you, Doctor. Again, if you do need to leave, appreciate your
Well,
time.
thank you all, and I'll see you in another space. You all
Thank
have a
you,
great day.
Doctor.
And
Feel
thanks,
free to.
Raul, for the invitation.
Of course, yes. If you guys enjoy these pieces, definitely give me a follow so you can keep up with various topics and speakers that jump on pretty often. Again, this was completely unplanned. It started with Michael Green and transitioned to Dr. Arnas, so it's been a great conversation so far. Weimar, any comments on the market actions today?
I mean, it's a little bit surprising, but the fact that it, rallied back to green on the day. I mean, I think almost everyone was expecting some kind of sell-off today, which it certainly had this morning. I think the bond market being closed, though, is going to be a big dynamic. Biggest thing I'll be watching, though, in the next week, we have bank earnings coming. PNC, I think, is the big regional, and then you have a bunch of the GSIBs from the USA are reporting towards the end of the week. I think it's Friday, if I'm not mistaken. So,
Friday,
it'll be really
yes,
interesting.
you have BlackRock, JP, United Health Group. That's not a bank, but another big name reporting.
Yeah, and I'm pretty interested to see. One thing that I can't wait to see is what Capital One did with some office CRE. They sold terms unknown. It was about $1 billion portfolio. So it'll be interesting to see what they actually got for that.
Michael, any thoughts on PPI and CPI as we gear up to get that data as well?
Sorry about that. I think the interesting part about PPI and CPI at this point is actually all about what gets left out and what the trend change is or what the second derivative is on many of the items that are out there. In particular, I know a lot of people have focused on the core services, particularly the Fed, the core services X housing. Almost everything I'm seeing suggests that metric has been trending down sharply. And the only things that are actually holding it up are what are called the imputed costs. And so just to very quickly orient people, owner's equivalent rent is the most famous of those, where you are attempting to estimate how much your housing costs. It's being linked directly to the cost of rental properties as compared to the cash outlay that you have. But other examples of that would be things like, what are the cost of banking services? And so those are defined as what is the spread between the risk-free rate that is available to investors should you choose to buy 3-month government treasuries relative to the rate that you receive on your checking account. That actually, crazily enough, has been a very large contributor to the inflation, because the interest rate increases have in turn suddenly conveyed in an imputed sense that people value or are pricing their banking services much more richly. Or likewise, the very rapid increase that we saw in the S&P 500 perversely shows up as increases in prices that we're paying for portfolio management services. Those year-over-year comparisons, those imputed components that are now making up a large portion of the quote-unquote inflation that we're experiencing, are starting to taper off and roll off as interest rates have stabilized broadly for the past 12 months. I think it's hard for a lot of people to look at 2-year rates or 10-year rates and acknowledge that by and large they've been stable but volatile over the last year. So those are the things I'm going to be watching for very carefully. I realize that I'm non-consensus in my view that inflation is behind us. What is not yet behind us is a return to the prior price level. If that happens, I think we're in a world of trouble, because there's so many debt contracts that have been restruck that presume the value of the assets is at their post-pandemic level, that it could get very ugly very fast. But that's what I'm watching on the inflation front.
Thank you, Mike. I'm curious if Bill has any thoughts. I see him in the audience. He's usually watching some interesting stuff as well. Let me add him up.
So just
Noah,
on the home
anything?
inflation front, I just want to add,
Go
my
ahead, Wyman.
single-family residence went up 5% last month, according to Redfin. So
The cost
But
of the
yeah,
house?
that's like a
but just to be
comparable
very
sales type thing. So in my area, home prices are still skyrocketing. It's a good school district in a suburban area, and there's a shortage of single-family homes and all that type of stuff.
but none of that has any bearing on inflation.
Correct.
I mean,
But I wanted to point out,
just to be very clear.
yeah, I wanted to point out that there's still that real dynamic to the consumer, where home prices are still rising, and that there's a lot of people who would like to buy a home right now who can't.
So I think that's actually a really important distinction, though. There are an awful lot of people who would like to buy a home but can't, and as a result, the home transactions that are happening are basically matching people who can afford to buy and those who are willing to sell into this environment. That's not that's not a fluid market, right? Usually, you have people who want to buy who are going to comparison shop, evaluate other things, etc. The shortage of inventory is starting to break in places like Austin. It is breaking. I'm watching Philadelphia fall apart before my eyes. Um, these California is extraordinarily short on inventory, but it is starting to build and change. And so, that may continue to be true a year from now. I am skeptical of it, though.
And just really quickly, and thank you, Raul, for hosting this space. I do apologize for slightly not being present for the last hour. I have a I have a meeting I have to continue attending, and I will be leaving after this question in that sense. But to Michael, I was curious, especially in the scenario that you're saying inflation is behind us, is there a scenario where inflation could peak considering the muted reaction one we had with the Middle East contentious situation and clearly more inflammatory geopolitical environment that we're walking into? I would not think that we're actually coming out of a situation where we're at risk of less dramatic situations occurring on the geopolitical event. We're actually at risk of more contentious situations occurring, and how markets, especially U.S. markets, would interpret that. Just as like a quick recap from what we were discussing.
So I think, look, I think your observation could very well be true. Stuff happens in advance, and I think that's one of the things that at least about what is playing out is that the underlying data in one form or another say something along the lines of it's obvious, right? It's obvious that we're in a more inflationary environment. Just look at the strikes that are going on. It's obvious that home prices are going to continue to rocket upward. The point that I was with Ernest about resilience.
Michael, unfortunately, you're coming in and out.
Okay, I apologize.
I am genuinely curious to what you have to say. So if you could get that fixed, that'd be a pleasure.
30-day suspension. Let me try again. Can you guys hear me now?
Yes.
Okay. So the point that I was making is that what causes inflation on a durable basis is actually an increase in demand. It's caused either by the urgency of demand that exists around something like a war, or it's caused by the emergence of a entity like China, as we saw in 2000, where it needs to scale up as up to put its labor to use. It has far more attractive ways of using that incremental energy, copper, cement, etc. So when you think about that underlying dynamic, I just don't see it out there. I'm not sure where this incremental user or source of demand is coming from when I'm watching everything else, by and large, collapse around me. Yeah. Just give me 1 second. You want the 5 back instead? Exactly. Sorry, I'm just getting change. And so like that's a big chunk of what I keep trying to focus people on is like if I look at the global population pressures, if I look at the emerging markets, I'm just not seeing where it's coming from. I'd love it if somebody would explain to me where they see this large incremental growth coming from, but I just don't see it. That was a genuine question.
I definitely think you have an added point there, especially when we're looking at global demographics and the decreasing population that we have. It's a natural situation that we might just unfortunately go through, right?
Well, I want to emphasize this. Not that it's decreasing population per se, it's decreasing population growth, right? And so there are regions around the world, particularly in high consuming areas like Europe, to a much lesser extent North America, where we are seeing negative population pressures. Um, but it's not actual outright population declines like we're seeing in places like China, like Japan, increasingly like Russia. Um, these are all areas. Ukraine obviously has negative population pressures, not to overemphasize any of this stuff. But when you have negative population pressures, like every year that goes by, there's one less pantry to fill, fewer mouths to feed, and people focus on the production side of the equation. But part of what we see across the developed world is that people actually are not all that important in the production function anymore. Certainly not of the things that we consider as baseload consumption.
So, and this is going to be one of my final questions after you answer it, but your argument is on a longer term, our greater risk is due to these situations is a disinflationary pressure within economic activity in that sense. And like you said, one less mouth to feed, one less pantry to fill, right? I think we may have lost you, unless it's just me not being able to hear anybody.
Sorry.
Michael.
Yeah, what you were saying to me, David, was that the longer term risk is deflationary associated with population pressures. Was that your question?
Well, a disinflationary slash deflationary, how you would want to caveat that. But yes, in relation to one less mouth to feed, one less pantry to fill, as you just analyzed. So, in my interpretation as to like a volatile inflationary environment currently due to this inflammatory geopolitical state, on a longer term, the greater risk is this disinflationary type pressure that might arise due to the demographics and the shift in consumption we see.
Well,
And I just don't get that. I mean, this is like 0. What 0.01% of the whole world is involved in this. I mean, I think that's a pretty far out discussion. I mean, I think we're talking about black swan events at this point.
well, wait a second. I just want to make sure that I understand what you're saying. You're saying that depopulation is an experience that 0.1% of the world is experiencing?
I mean, I think David is making the point that millions of people are going to be dying in war, and therefore.
Oh, no,
Oh
no,
no
no,
no
no.
no!
We
But
weren't
no
talking
no no
about
no
war at
no no
all.
no.
No, that's not what we're talking about at all. To be blatantly clear, war is inflationary because war actually creates an existential and immediate demand. You don't worry about saving for tomorrow if you're trying to stay alive today. Right? War takes all the surplus resources of society, it concentrates them into the point of the spear and says, use them now or else. That's what war really is. And so part of the irony is that we really haven't fought wars like that since World War II. You're seeing elements of that in places like Ukraine, and you'd have to be an idiot to not look at Ukraine and be like, okay, that's inflationary in Ukrainian terms. In the same way that Russia is now taxing its exporters, despite the fact that it desperately needs hard currency, precisely because the inflationary conditions that are created by those dynamics are putting downward pressure on the ruble versus the rest of the world and creating windfall profits for exporters that the state is now capturing. That's a radically different statement than saying that the long-term dynamics of population pressures being negative is disinflationary in its structure. If we have war, if we have a world war, like nobody is arguing that we're going to have deflation under those conditions. Right. So if you're arguing for inflation on the back of those dynamics, then I would argue, well, you're the one who's saying the 0.1% probability. But your base case expectation, barring some of the really horrible outcomes that we're talking about, has to be that the world's surplus continues to grow, and that causes negative inflation pressures or disinflationary pressures.
David, maybe you can clarify your question.
So yeah, it had nothing to do with the actual physical death count that this war or these inflationary, inflammatory type geopolitical environment would cause. It's specifically the increase in inflation costs, right? What we saw in supply chains, as Michael just beautifully alluded to, it's this increase in demand, immediate demand outside of your actual population. What I was saying is my perception currently, because of this inflammatory environment, we have an increased volatility in inflation and in the perceptions of inflation versus disinflation in one's economy. And on a longer term, the more pressing issue is the fact that we might have this demographic shift that really does affect economies in ways that we're not appropriately calculating. And that's where the main consensus is. And the long term is essentially like a 10 to 15 year type time frame, right? Where we're going to see, like what Michael was alluding to, one less mouth to feed, one less pantry to fill. And how long is that going to magnify? That also implies one less a pair of shoes to be consumed, one less computer to be consumed, and so forth. And so by definition, I think that is something that's a precedent on the longer term, and no notion of black swan, just mechanical structures over the data, right?
But I mean, you have China now, they've just stopped their one-child policy. So I don't think it's a foregone conclusion that, population is going to decline. Maybe in certain developed economies, you have, a demographic shift, but then in the developing world, so I don't see that net effect.
So just very quickly, China removed its one-child policy 7 years ago. Their population birth rates have continued to collapse. Korea certainly doesn't have one. Japan certainly doesn't have one. Western Europe certainly doesn't have one. And you've seen the same behaviors over and over and over again. The population explosion that you experienced over the 20th century was largely an accident. And now you're seeing that process reverse itself.
I see we have Michael Cow here who can probably give us some great additional perspectives on oil and energy. And he's a friend, I believe, of Michael Green as well. So it would be a great time to bring him up. Hey, Michael Cow, I'm sending you a speaker invite. Hey, Benjamin, looks like you're back. If you'd like to continue moderating while I try to ping Michael.
Actually, Weimar had his hand up. Did you have a question, Weimar?
Yeah, I just wanted to say on this whole like peak consumption thing, a lot of people get on because of demographics, which are very real in many countries. There are demographic issues, falling workforces over the next 20 years, etc. You have to also remember, though, just the incredible number of the world population that is basically living at a fraction of US standards and continuing to move up that income chain. So, like, you are going to see massive demand growth through the years continue, even from China, who has economic problems up ahead. I acknowledge that. But over the next 10, 20 years, I fully expect their consumers there to consume more, even if their population starts to actually fall in 20 or 30 years or whatever it's expected to be. Same thing in India, although probably even stronger because they're starting from an even lower baseline on per capita income. So just keep those things in mind when people are talking about demographics. There are new sources of demand coming, and a lot of it pertains to how high your income rises, how much discretionary consumption you actually have.
On the flip side of that, though, Bill, you're actually seeing in many of the commodity areas in particular falling consumption across the West, right? Energy consumption across the West is actually lower on a BTU basis, much less on a carbon weighted basis than it's been historically. At the same time, you look at countries like China, and you could have made the exact same argument about Russia in 1989. You would have been totally incorrect. Right? There is nothing that guarantees in advance, particularly for a country like China that has chosen to take the model that they've used, which has been largely exploitive to the rest of the world, right, and have abused it, and now they're taking for granted the fact that they can continue to do so. Japan's consumption is lower than it was 30 years ago.
Yeah, but do you really expect all of South, like even if China does that, like Southeast Asia, India, some of these other countries, these are massive population centers. You have all of Africa, they're living at effectively poverty levels, and their income per capita is rising pretty steadily through the years as well. So this is just huge groups of people that are going to be moving up and having more and more disposable consumption capacity.
So, which countries in Africa in particular would you point to? Would you highlight South Africa, which is by far the largest economy and has seen falling living standards? Would you highlight Mali, which has seen falling living standards? Would you highlight Rwanda or Burundi? Which countries are
I
you
don't know. I
referring
don't
to?
know if that's actually all true. I'm sure South Africa is because they were a developed country and they've kind of reverted back more and more to due to a lot of political issues. But I do know for a fact that over the last 10 years, standards of living in Africa have actually risen and they've risen considerably. And that's a huge population that's going to keep growing. I think eventually Nigeria is projected to surpass the size of the United States just in terms of population. So there's still huge embedded growth around the world in that regard.
Yeah, I would just be very, very careful in those types of projections, right? Remember, the reason why those projections occur is because they're projecting forward historical numbers. If you actually look at the actual underlying dynamics of Nigeria, it can't possibly grow to the levels that they're actually talking about. The population pressures and the inability to actually provide for itself switch very, very rapidly. So, I mean, this is a pattern we've seen across the world. The projections for global population have been falling now for 30 years. They're going to continue to fall almost unquestionably. And all of the forecasts that we see actually presume a rebound in fertility rates that is so far completely failed to materialize. And all the behaviors that we have suggest that that's going to continue to be the case. Again, China lifting, one-child policy restrictions and seeing its fertility rates fall was not on many people's bingo cards. I think it is actually fairly obvious, even if you went back to 2011 and the articulation that China spends 40% of its income educating its children. Well, if it has one child, how many children can you educate with 40% of your income going to educate that child? Right? The answer is one. And if you make it less than one, your living standards explode. And this is the challenge that we're facing all over the world.
One thing to note, Michael, is that the EIA did come out with their latest estimate on global oil demand, which they put at 102 million barrels a day, which is at a peak level. We've particularly coming out of COVID, and it feels like that line, though it might be slowing down, it continues to incrementally increase, and it doesn't feel like the supply is going to be able to keep up with that globally incremental increase in demand. And this is despite flat oil consumption by the US and Europe over the last decade. So much of that increase in incremental demand is coming outside of the developed world.
Right. And what was the forecast for EIA? What was EIA's global forecast for oil consumption in 2004?
Don't know what it was back in 2004.
Right. I mean, this is a part of the point, right? If we go back and we look at the forecasts that were made back then, in terms of where we'd be today, it was somewhere in the neighborhood of 119 million barrels a day. We're roughly running 25% below forecasted levels, even from 2010. And the 2010 numbers, crazily enough, have been revised somewhere around 15% lower than we thought they were at the time. So the simple answer is we never actually really know. You mentioned Nigeria earlier. Nigeria is one of the primary areas in which black oil or black market oil makes it into world markets. We don't really know exactly what production is. We make a big show of the accuracy of our data, but we just don't know, and we genuinely don't know. We cannot predict how technology is going to change. But it is changing, and every time we raise the price of energy, we raise the price of gasoline, we move faster towards higher efficiency vehicles. We lower those numbers going forward. And I think that's been one of the biggest stories. I mean, I started the year off writing a piece on oil in which the projection was we're going to get to 106 million barrels this year, right? Clearly did not happen.
What are some of those innovations that you're seeing? Is it in lithium technology? Is it the increased efficiency of hybrid vehicles? At the margin?
It's all of the above, right? I mean, so like just stop and think about this for a second, right? We develop new materials that makes for lighter vehicles. We develop better insulation that makes for lighter vehicles, lower fuel consumption. We switch to self-driving vehicles. Suddenly nobody cares how fast you get from 0 to 60. the growth in auto markets is increasingly tied, as you point out, to electric vehicles or hybrid vehicles, which use far less energy intensive on the back end. And the technology, the batteries that we're using in those are becoming longer and longer lived, and they themselves are facing higher capacity components, and eventually we'll hit to a switch dynamic. And the key thing with electricity to remember is electricity is not actually a fuel source. Electricity is actually just a mechanism for transferring energy from one location to another. It becomes totally flexible on the fuel source. So once you switch to electric vehicles, just like you switch to an electric house as compared to a wood stove, you suddenly introduce flexibility on the fuels that allow you to radically change underlying structures. We just don't have it yet, but it's coming.
Likewise, switching gears on the fiscal front, you've written in the past that you're not so concerned about the fiscal outlook, the so-called fiscal impulse or driver of potential problems down the road, because you think that ultimately we are going to see some sort of policy response to bring that in. Do you anticipate that we may see some bringing back in that fiscal impulse over the next year as a result of what's been written about that this could be a potential driver for the higher real rates that we've seen this past quarter?
Well, I don't. I think that the higher real rates that we're seeing are a byproduct of a market that does not have the capacity to flex its demand and take in the much more attractive bond, and therefore bond prices have to fall, leading to much higher interest rates. I think if this were actually coming through in the manner that many people describe, it would show up as dramatically lower equity prices for at least some segment of the economy that's tied to the more traditional areas. We're just not seeing that. Right, so like a far more elegant explanation doesn't mean it has to be right, but a far more elegant explanation is just that the markets are increasingly segmented into capital pools that are able to do one thing but not another. Right, so again, I mentioned this earlier in the conversation. Warren Buffett had the flexibility to say, do I buy equities or do I buy bonds? Right, if you give the money to Vanguard and its total market index as part of your 401k directing towards a target date fund, it doesn't have that flexibility. It can't look at bond markets and say they're more attractive than equity markets, therefore I'm going to increase my allocation to equities. And so when you have markets that are no longer integrated, they're no longer actually referencing each other and saying, where is the attractive place to put the next piece of capital? The pricing signals that we're getting, I just don't think mean anything.
That's interesting because B of A does fund manager surveys, and the one that they published at the end of September showed a historical overweight to bonds by their surveyed audience versus history than any time that we've seen. So it's like 2 standard deviations overweight on bonds. But given the prevalence of passive investment vehicles, you feel that by itself, that preference among fund managers to be overweight bonds isn't enough to push the needle on pricing?
So again, I think it depends on the definition of overweight, right? So I can't possibly know what your definition of overweight and what my definition of overweight actually mean. But more importantly is the point that you were making, and this is one that I have with Michael Hartnett, who produces that survey all the time. It's like, Michael, you're talking to people who are losing all their assets. You're talking to people who have the time to answer a survey. Vanguard doesn't respond. BlackRock doesn't respond. Right? There are no passive managers responding to these surveys. And that's where all the money is going.
That and private markets, certainly. We've seen a lot of supply.
Well, I mean, we're slowly seeing private markets switch, right? You're slowly seeing private markets rotate from private equity to private credit, right? But private equity is still 10 times the size of private credit, particularly once we factor in things like venture capital. And those still are getting allocations, even though almost anyone who rationally looks at it can look at private equity and be like, yeah, that business model doesn't work at these levels of interest rates.
Got it. Thank you. Busty, you've had your hand up for a while. Do you have a question for Michael?
Yeah. What level on the 10-year is PFIX tied to now, Mike?
PFIX is not tied to a level on the 10-year per se. It does own 10-year bonds in terms of its underlying construction, but that's actually ballast within the portfolio. The reference for PFIX is actually I believe it's currently a 5-year into 20-year payer swaption, which references a payer contract on forward rates. And I believe the strike on it, I apologize if I don't have this correct, but I believe the current level of that strike is around 450 against that 5 into 20.
You guys hold like a little office party for Harley, since that thing's probably been like the best ETF now 3 years running.
2 years. If we're lucky, this will be the second year in a row it's the best performing ETF. That's okay. We hold parties for Harley and funeral dirges for me.
Was
Okay,
Harley even surprised by
that.
the level of steepening that we've seen over such a short period of time?
Harley is very concerned. But this has been Harley's argument for the product all along. It's just that you buy PFIX or you buy protection because you don't know, not because you know.
Got it. Understood. Weimar, you had another question?
That's more of a comment too. A lot of people are looking at the Treasury's issuance and demand for it, and there's certainly some constrained buyers among banks for a variety of reasons I've talked about before. But another thing that needs to be kept in mind is that the private market debt issuance maturity wall is starting to hit now. It is just beginning. You can watch spreads. They're starting to widen for things like your subprime debt. The spread is back to near 10%. For the triple C and below. So that's going to be something to keep an eye on too, because you got to remember that, this money, it's not just looking at the risk-free rate, which is the treasuries. It's also, a lot of these managers have to beat that rate, and they look at, what they can make out there in private bonds. So not the government.
Chris, you had your hand up. You have a question?
Yeah, I do. For Michael, but in general, I think my biggest issue with the pro-demand, pro-supply arguments going on for oil or commodities or demographics is they all assume continuity. And my biggest concern going forward is just the increase in prevalence of conflict going on globally. And I think it speaks to a more increasing probabilistic scenario where you're seeing just fights between Azerbaijan and Armenia, Russia and Ukraine, Kosovo and Serbia. I mean, at some point, this spills out into the pathways for everyone's demand and everyone's supply. And that concern, I don't think it's going to decrease. I mean, at the end of the day, part of the argument for why now for Hamas into Israel is there was a potential security agreement or normalization occurring between Saudi Arabia and Israel. And the reason for that was because the U.S. has historically or recently shown less of an interest in guarding every sort of trade route and pathway globally. And that right there is the tail risk, and also maybe not even a tail risk, maybe even just almost an expectation. I mean, China and Taiwan, India and China, it's nearly global at this point, where there's just conflict after conflict, more so than you've seen historically, starting to sprout up. And at some point it spills over. At some point it affects some trade lane, some maritime pathway, and it causes disruptions similar to that of COVID, but in a harder to fix manner. COVID can be kind of adjusted for to some degree. You can't adjust for insurance with the tankers, or tankers not being able to get to port, or that kind of stuff. I'd love a commentary around that point.
So that was the concern coming out of Russia, Ukraine, right? No one was able to get maritime insurance coming, everyone was afraid of getting caught with Russian Urals, say, ship it off market, or not being able to transact below the price cap. But we've not seen the trade ecosystem collapse per se. And the similar concern was brought up with the banking system in March and April, that we would see a total collapse in U.S. Regional lending. And in a lot of ways, we've seen banks pull back credit. We've seen them pull back lending, but in a lot of other ways, private markets have kind of picked up some of that slack. So we've not yet had that major breakdown in the mechanisms that Chris was warning about. Michael, is that something that keeps you up?
Well, when you say keeps me up at night, the only reason it keeps me up at night is because I have a son in the military. And I agree, by the way, that the risks of large-scale direct conflict are rising. But they're far from givens, and this again goes back to the comment that I raised with Anas Alhaji, is this idea of how robust is the system, and is the system potentially less fragile than we think. One, the longer we persist in this system, where it becomes more obvious that the US is moving towards conflict with China, that actually raises the incentive, and we've already seen this with a rapid increase in the quantity of onshoring, a dramatic increase in the quantity of trade with Mexico, for example, that is far less tied to that underlying dynamic. There's also significantly less labor content in many of the new products that are being introduced, and therefore it's easier to onshore them than they might have been in other areas, right? And so I don't think it's inevitable at all, the scenario that you're describing, right? The deglobalization phenomenon is possible, but I don't think that it's actually a given at all. What seems increasingly likely is that China finds itself increasingly written out of the majority of the global trade system, in the same way the Soviet Union was largely written out in the 1940s, 1950s, 1960s. That's the risk for China. And it feels like they're heading down that path. If anything, that lowers their purchasing power and creates very different conditions than the ones that you're describing.
Ravi, you had your hand up. You have a question?
Yeah, I think very good points by Michael. I think it's really critical, but also Michael, the other piece is the demographic and the aging population of China, because I think that really raises the question about both the consumers, but also the whole manufacturing sector in terms of having the right folks really catering to the global market. So I have two questions. I don't know if for you, Michael, and other folks listening. Sorry, on the panel. Really, this whole issue of China being moving towards decoupling, and you're looking at China plus one, plus two, whatever. I think, do you really think that economies like India, Vietnam, Indonesia, Malaysia are really ready for looking? Are you being the base for manufacturing? And if so, of course, India definitely has an advantage because it has a huge youth dividend, and there's a lot of work happening on investing in skilling and trying to. We've seen successful examples of the Samsung Gigafactory. We've seen the Apple, plant, and many others slowly moving in. So if that happens, I mean, where do you really see the markets from the global perspective? In terms of the Indian market, and also India and US coming together. So one is that question, and second, of course, my speculation I put up in the tweet here is really, I think, in terms of where the world is. We know very clearly that this entire Middle East conflict with Iran, and Iran really is backed very much by both the supply and by support from China. And isn't China really shooting its feet in many ways? Because ultimately, it should try to actually be with the world, and it already has, the whole opportunity right now. But it's going that USSR way, right? I mean, Russia, of course, later, but USSR also got into, let me get onto the side. We are more self-reliant. And what will it really mean to the Chinese economy and China in the long run?
So this gets to the issue of
Well,
whether global security trumps economics or not, right? And in the case of Russia and China, they don't necessarily trump economics.
well, so a couple of quick things I would point out. I mean, my perspective on China has been heavily informed by the challenges that China went through in 2013 when Xi came to power, and China basically made a fairly clear statement that their single biggest fear was repeating the mistakes of the opening of the Soviet Union under Perestroika and Glasnost, and that they were afraid of repeating those errors, quote unquote, that led to the downfall of the Soviet Communist Party. Once you make that choice, once you decide that's not the path that you're willing to go, then you've almost inevitably declared you're heading in the opposite direction on the J curve. You're moving towards an increasingly locked down and shut down society that is ultimately headed towards a Stalin version, right? As distinct from Mao. right? So Mao has very different dynamics than Stalin. Stalin took an economy that was increasingly open to the West and closed it because of the desire for political power. Post World War II, there was the opportunity for them to be very active participants within a broad coalition of allies and chose not to participate, pursuing ideology over integration. And many of the advances that we talk about in the Soviet Union, for example, the emergence of Sputnik, the nuclearization of the Soviet Union, et cetera, were like what we're seeing with Huawei's phone and 7 nanometer chip, right? They are effectively new technologies or old technologies that have been brought very quickly over through a combination of theft and general creativity, right? But if you declare that this is what you're going to do from a command and control economy, you can actually be remarkably effective. But what you lose over time is that innovative edge that's caused by saying, how can I solve somebody else's problem and get paid for it, right? If you're trying to solve one person's problem, an autocrat's problem, then you get very different solutions, and they ultimately become very much stunted in their innovative capability because you spend half your time watching your back politically, right? That's one of the amazing things about a capitalist system is I don't have to figure out how to solve the problems. I just have to pay somebody who does, right? And that opens up incredible flexibility. I think China, we're actually watching them move in the opposite direction. People look at the Huawei chip and they say, like, oh my gosh, look at the capabilities of China. I'm like, oh my gosh, like, can you believe it took all those resources to actually accomplish that dynamic? May they at some point lead for a brief period of time? Sure. And can there be radical changes in technology like artificial intelligence that actually meaningfully changes my analysis of it? Because we do end up crossing something like the singularity where it's impossible to predict that the patterns of the past look like the patterns of the future. Of course, that can happen, but I think it's a relatively low probability event. And ultimately, I just look at China as it's a failed model that has failed repeatedly. We know that command and control economies have certain advantages during certain periods. They can't, 25 people trying to play a game of chess are going to be less strategic and less effective than one person playing a game of chess. But 25 members of a chess club are going to do a better job of working together to come up with strategies to beat another chess club than one player.
So, Michael, in terms of getting back to the question of India, and maybe to a lesser extent, whether we see some of the other capacity pickups occur across Southeast Asia, across Vietnam, the Philippines, Indonesia. Do you think that other countries are going to try and adopt a similar mercantilist framework for growth that Japan and China had pursued over decades, or do you think we may see a different path for them?
Um, I think that's a really hard question, right? Because there's so many open-ended components. Of course, I think there will be other countries that pursue mercantilist approaches, and I do ultimately think that that underlying dynamic of "quote unquote" subsuming the immediate needs of your consumers for the benefit of the state actually can be really valuable, right? And the United States did the same thing, by the way, by instituting fairly significant tariffs early in our development stage, right? That was unfortunately part of what the Civil War was all about. Um, So I don't think there's anything uniquely bad about a mercantilist approach. It's just a question of does the mercantilist approach ultimately serve the objectives of raising standards of living broadly, or are they used to raise standards of living to an extreme extent for a subset of the population? And that's really what you've seen in China, right? You've seen the enrichment of the CCP, the creation of extraordinary power and wealth, um, while many people outside of the major cities have continued to struggle. The aging of China, like, I don't know how else to say this, right? I mean, I expect actually a full blown, at some point, articulation that China simply can't care for its old people, and therefore they're going to radically degrade their standards of living in a manner that's not dissimilar from what happened to the Ukrainians with the Holodomor. And I realize how horrific that is, right? I just want to emphasize I don't wish this on the Chinese people, but that is the direction that it is heading. Um, and India is actually a really interesting one, right? Because India actually has something unlike any other country that has ever risen to relative prominence, which is when they get rich, they don't consume beef. And that seems like a really minor observation, but it's actually a huge one because much of the resource intensity that's caused by raising living standards is actually caused by dietary change, moving away from pulses and vegetables as sources of carbohydrates and protein to beef in particular, which is 32 times more intensive than wheat as a source of caloric input. Um, and so, like, that's just not going to happen with India. And it might legitimately be the first time we've ever seen something like that occur. I think actually the really interesting thing about India rising as a power and increasing the productivity of its population, by the way, lowering the caloric intake of its population, because India, because it is so manually labor intensive, actually has remarkably high levels of caloric intake already. I think the standard of care in India is something like 2,700 calories a day versus the United States at 2,000. Um, and again, that's just a byproduct of they work harder than we do, physically work harder. Um, you know, you're actually talking about creating extraordinary surplus when you talk about the rise of a country like India. And so, I don't know. I mean, I look at it and I'm like, wow, what an incredible world. And then I go a step further and I say, what does India look like? Not only advantaged by all of the technological innovations that we've made just in the past 30 years that have the potential to magnify human labor content in a place like India, but even going a step further, looking at components like AI, which is just coming on, and India is a relative knowledge leader. Like, I mean, what happens? What does a call center look like when it's AI enabled? Right? What does that mean? We don't even really know. Right? We can't deglobalize in the traditional sense because, among other things, look at what's happening to the news that we're getting out of the Middle East today. Right? I was pointing out to my family, if you go back and you look at the first Gulf War, the images that we would receive, the reporting that we would receive at that time was totally grainy and completely interrupted. It was basically like my Twitter Spaces connection, 10 times worse. Right now, we're getting high definition fidelity stuff coming out of in real time, coming out of the Middle East. We're saying like, hey, what's going on in Israel? Well, here, let's look. Right, all of this stuff is actually really changing, and it creates combinatorial possibilities in terms of resources that didn't exist during the rise for China. And so I get worried about a lot of things, right? I get worried when everybody tries doing the exact same thing. I get worried when we decide that things are, a foregone conclusion, right? Because I think all that is crap. But I really struggle with this idea like the world is going to come to an end because, China. I just don't see it.
Ravi, you had your hand up, and then Weimar.
Yeah. I think excellent points by Michael as always. Michael, you'll be amazed that when the world was going through COVID, I was working on a project with some folks in India with Microsoft and the government. They were training about 5,000 teachers between the year 2020 to 2022. These 5,000 teachers was training middle school students on AI skilling, and that last year that program was then elevated to another like
Looks like we lost Ravi. Ravi, if you're back on, then please feel free to request. Weimar, you had a question?
Oh, it was more of a comment. I was just going to say one thing to keep in mind on India. They may not eat beef, the Hindu portion of the population, but there's still a Muslim portion of the population. And it's getting close to like 180 million people, I think. So I don't think they have any qualms about beef and other ruminants.
Yeah, but certainly it feels like the general ethics and culture of India are driven by the Hindu portion of the population. I could be wrong.
No, you're absolutely right. I think this piece on I mean that I was going to comment that second, but maybe just carry on and go back to the AI piece. I think it's amazing. It's not only that it's about red meat, but there is this growing culture with Gen Z, which is really looking at becoming more going back to the traditional vegetarian diet. I mean, not that because I'm vegetarian, I don't eat any meat and stuff, but generally there is that stronger consciousness of not really linked to only religion, but also to the environment, which is a new trend. I mean, I know that many corporates now, when they do many of these big lunches and events, they're all now going vegetarian. So coming back on the AI point, just to complete that, Michael, so this entire initiative, which was only looking at 5,000 teachers, and I was in a very interesting conversation with the Central Education Bureau in April. I was back in Delhi, and I asked, what about Chat GPT, and how does that really impact your scoring and everything? And this teacher is from a government school, and this is not like elite schools, okay? This is not private school. I'm talking about the public schooling system in India, right? And she said, we don't worry, we're going to change the way we did examination. Earlier we did all the scoring, but now we're going to go back to the oral tradition of India, and that's how a lot of learning was done, so that we get more reasoning. And even if you want to go on to ChatGPT, go ahead. We love it, as long as you're researching and you have the right answers. But we don't want you to give us a written submission. Give us an oral discussion. So there is a very strong push by the government, and I had in one of my Twitter spaces the Union Minister for Technology about 3 weeks ago, and he was saying that the amount of money that India is pumping in on AI initiated startups is mind-boggling. So definitely there's a huge opportunity right there, and I think we'll be bringing some of that discussion in New York later in November. But fantastic points, and I really like your point about the diet piece. I hadn't really thought of that. That was a very significant point.
One other thing I wanted to point out, just going back to the diet in India, because this stuff fascinates me. I think India actually has more cows than the United States, because although they don't eat them, they have them. I think that their head of cattle is like double or more the size of the USA.
That's interesting. I'm wondering if they just let them free range or if there is actually an industry around that, maybe an export
No, that's
industry.
by design. That's by design. If you went into Hinduism deeper, actually cows are considered sacred. That's why beef is not eaten and cows are worshipped. So they actually try to grow farms and cows and preserve that species.
I mean, just give you an example. The cow dung, unlike here.
Ravi, it looks like we lost you again.
Oh, sorry. Can you hear me now?
Yep.
Yeah, I was just giving an example that it's just not the cow in terms of meat, it's also that cow dung is used in many villages to move away from the old traditional stove into something called biogas plants. So they've been very successfully able to really look at the cow dung as an important part of gas, but also they've been using a lot of this for organic fertilizer. So there's a huge industry. I'll try to dig out something and pin it here for you guys to learn. So there is definitely an issue of manufacturing this huge amount of managing this cattle herd. There's a lot of work which is happening around that area.
So looking ahead, we have some key inflation releases coming out on Wednesday and Thursday. We have the PPI on Wednesday and the CPI on Thursday. Um, I don't think that those prints by themselves would cause a major shift in expectations on the part of the Fed or on the markets in terms of what they're going to do near term on rates, but it does feel like more and more that unless we see a major upside surprise or outbreak and so-called second wave type of risk, that the Fed is done. And even though there's a greater than significant chance that they may raise rates once again in November, December, it does feel like that 575 or 550 is where it's going to be the terminal on Fed funds. The only question then is when do they start cutting rates next year? And Mike, I know you've written quite a bit on this, and you feel that the Fed has made a lot of mistakes in terms of tightening policy way beyond where it should have. Um, Given where we are now at this point, do you kind of are you sort of in line with the baseline view of what the rate path is going to be over the next year?
Well, if my theory is correct, we'll end up seeing them cut much more rapidly than is priced in. But they're entirely plausible to sit here until something breaks. And I agree. I mean, you're hearing it from Lori Logan, right? Like they're genuinely confused about what do they do because their perception is that inflation has not fully responded and come back below target. Um, that's certainly true on some components of it. But most of the evidence that's out there suggests that the long and slow moving components like rents and owner's equivalent rent, which accounts for 40% of the core CPI, that those are actually moving into negative numbers.
So that by itself, I mean, clearly Powell's measure of supercore or core services ex shelter is trending in the right way. I would think, though, that the Fed would want to err on the side of caution and not come across as trying to be so vigilant or so Volcker-like in terms of setting expectations for the near-term path. But that doesn't appear to be the case.
Well, wait, and you say that doesn't appear to be the case. You say they are following a Volcker-esque
Yeah,
path.
that's what I meant. Yep.
Yeah. No, I agree. I think this is part of the reason, unfortunately, that I raised the alarm very early on. Is like I actually can't believe that they're repeating the mistakes of Volcker, but they are. And I think it's a natural byproduct of you having somebody like Jay Powell who strikes like all my interactions with people around him suggest that he's quite smart, but intellectually incurious.
Rahul, you have a question or a comment?
Yeah, just a quick comment. I'm glad you brought up CPI. We actually have a pretty good spaces lined up on Thursday in which Michael's invited to as well, along with Default and many others. And Ben will be co-hosting with myself. So that link is pinned above if you'd like to set your reminders. We'll be live on Spaces Thursday, 8 a.m., talking CPI before the print, once it's released, and then also post-analysis. And we have a ton of great speakers tuning in for that. And also Ben actually wrote a piece today for the One Read, which is above here as a co-host, which is our free newsletter, kind of previewing CPI and some more details. So if you guys would like to subscribe to that, it's totally free, and that'll be coming out in another hour or so. So you can kind of read that as well. Again, it's a free daily newsletter, completely free and easy to read. So you can just click on the co-host over here and then go check that out. I see Default and Rockcore here, so curious to hear your thoughts on the markets or oil or anything you'd like to chime in on.
What's up, guys? I mean, as you know, like I've been a oil bull all summer, and it just seems like a lot of these narratives people thought were just like overbought. It's just, they keep pushing higher. But for me, what I've been pretty much doing today, I know the obvious play was like long oil in the defense sector, like everyone knows that. But for me, just like coming at it from a technological background and perspective, I think like the cybersecurity like industry by and large has not gotten any attention during like what's been going on. And in the year 2023, this is just as much a part of war than like Halliburton or Raytheon is. And if you look at like a lot of these big names like Cloudflare, CrowdStrike, Palantir, Zscaler, they're largely down. They have similar structure, and I don't see how they don't catch a bid off of all this, because like I made a post about it earlier today that that is a lot of what goes on with behind the scenes. The average person isn't really aware of it, but there is a whole nother war that goes on online between like nation states, and so they allocate quite a lot of capital and budget towards securing their their reign in cyberspace. So that's pretty much what I'm looking at right now is the cybersecurity industry.
So forgive my ignorance, Default. How much of that is tied, that sell-off in cyber is tied to just sell-off in Israel stocks in general?
I'd have to look into it because I haven't actually looked at this sector in a while. It is something that I've always been bullish on, just because of my nature of knowing that it's something that's never going to decrease in expenditure in the long term. It's just going to keep going up, because as things keep becoming more and more entrenched, we keep connecting more and more things to the internet. Everything's pretty much insecure. I mean, like our infrastructure, SCADA systems, everything is like we're using like legacy systems that are running on Cobalt, like the Swift banking system, and it's something that I've actually like allocated to my Roth, which is this says a lot for me. But yeah, I'd have to look into like the correlation you're talking about with Israel.
Rocco, it's been a while since we've had you on our panel. What is your take on what we're seeing in the energy markets?
Yeah, thanks, Benjamin. Raul, can you hear me?
Yes,
Yes, we
how's it
can.
going?
Good. Yeah, it's been a while. Just in a couple of sentences, because I want to say something else about the interest rates. I believe even without this Israeli Gaza Hamas war that's going on currently, it's still bullish setup for oil. I think the recessionary fears are still overblown, and I think I miss what Dr. Nas had to say, but I think we're going to continue to see even stronger oil prices due to the dynamics. But on the other hand, even though we broke out in natural gas above $3, the overall supply and demand fundamentals are still bearish. I mean, up until this up until this war started, but the Europe is about 97% full. And last year at the same time, they were 90% full. And they still have 5 weeks of adding to their inventories. So even though we've had this breakout, and traders tend to look at something when it breaks out and they all jump on, that's why you see the price move up so much off of a breakout area of $3. But I think that's going to come back down. And I've looked at the past 8-9 years, and you look in the fourth quarter, many times when natural gas has gone up in September or October, it's come back down in November or December and January. And I think we're setting up for the same thing. But that being the case, I do see much higher natural gas prices heading into 2024. But I want to say one quick thing. I spoke at the Silver Symposium at the Caesars Palace just a week ago. And the funny thing is, it's an interesting story. What it leads to is you pay an arm and a leg to get a hotel room there, and they don't even offer you a free cup of coffee in your room. So it was a joke that I shared with subscribers, and I realized the reason why Caesars Entertainment can't provide you with a free complimentary cup of coffee in your room, even though you're spending $300-400 a night at one of their rooms, is because they're paying $2.3 billion a year in interest expense. They're paying 18% interest. And then I looked at PG&E, Pacific Gas and Electric in California. Their interest expense year over year is up $200 million. They're paying 10% interest expense on their revenues. And so I think this is, I wanted to bring that up because they're the larger grid power for California, and they are paying 10% of their revenues just to service their debt. So I think interest rates are going to have to come down, or they're really going to blow up this entire market, and you could see it's changing much quicker now. So I just wanted to add that my 2 cents in on there.
We are pleased to be joined by Michael Cow, who might have a different take on the oil markets, seeing as this near-term pop is just being kind of a war scare premium, but longer term, Michael, you've been writing quite extensively that you feel Saudi Arabia ultimately is going to shoot itself in the foot with their production cutbacks. You want to distill your further thoughts on what you see happening with energy?
Yeah, I think. Thanks for having me. Sorry I couldn't talk earlier. These markets have been so volatile lately that I've pushed off lunches just to capture the last 10 minutes of trading. So, at any rate, so my view on oil has actually been pretty consistent, despite Fintuit's tendency to kind of cherry pick timelines. I actually turned cautious after being bullish on oil back in early 21, bullish to the point where I was Texas hedging my long-term private equity play with futures. I turned cautious in April of 22 when oil was around like 105, 110, saying that the effects of the Fed hikes are essentially going to start negatively feeding back into demand. And for the most part, that was actually the right call until we saw the big spike in the last 2 months. To set the record straight, though, I think that back in when oil was in the 60s, we had when Alex Stahl and I had that chat with Jack Farley, we said, look, it's going to be, there's the risk of OPEC intervention is high. I wouldn't go directly short oil, but I would look at oblique sort of chicken ways to hedge. And so my hedge since April of this year has actually been short the Chinese yuan. I've been talking about this thesis that, you know, because China is so dependent on their oil imports, and because the PBOC there is stuck between a rock and a hard place, much more so than even our Fed. You know, because of the stockpiling that they've done, because of their need to export their way out of a structurally slowing economy, they would have to devalue the yuan, and in turn, that kind of all things being equal, dampens demand for oil. I call it the CNY/oil doom loop. And so I used the Chinese yuan as an oblique way, a chicken way, if you will, to hedge oil. I didn't actually start hedging oil directly, and directly I mean through XOP puts, until August 1st. And so it was a little bit early, and then became kind of vindicated the last 2 weeks, and then we had the geopolitical events this weekend, obviously. So that kind of catches you up to where we're at. And I think I've been writing for the better part of a year now, saying that I think even though I put on this long-term private equity play for a 10-year bet, a 10-year structural bet. I think that in the near term meaning, you know, let's call it 6 to 12 to maybe even 18 months, that the monetary headwinds from global synchronized central bank tightening, not to mention the fact that OPEC has embarked on the series of cuts, which keep pushing off what I call this oil supply-demand singularity, like the holy grail that all long-term oil bulls, including myself, have been chasing, but have found it forever elusive, is this supply-demand singularity point where the world is completely out of spare capacity due to long-lived, capex starvation, to the point where even a recession-impacted demand will outstrip all supply. Now, a lot of the short-term bulls, that is my long-term thesis. It's always been my long-term thesis. The short-term, where I differ from the short-term bulls, is that I think that in the near term, the Fed is going to win this fight. And I've been calling these OPEC cuts as sort of tongue-in-cheek premature emasculation of itself. Because if you think about the Fed's tool to combat inflation, the Fed has one tool, it is the Fed funds rate. And so it's the one tool with which they need to bludgeon the economy and to the point where aggregate demand starts slowing down through presumably job losses, slowing economy, higher cost of capital, asset price losses, etc. OPEC Plus, which is the central bank for oil, has one tool. Its one tool is to limit supply, limit current supply, but increasing what I call forward elasticity. They're increasing. I think OPEC Plus spare capacity hasn't been this high since during the COVID period. So to me, the risk reward of being long oil here in a darkening macro backdrop is just not good. And especially when you consider that OPEC's weapon itself, right, has the perverse effect of both being demand restrictive, just like the Fed's tool is demand restrictive, but it has the perverse effect of also keeping the Fed more vigilant than it otherwise would be. I mean, perhaps if oil had not reared its ugly head again recently, maybe the Fed would be that much closer to really embarking on a pivot. But I think between the renewed vigilance that the OPEC cuts have produced, and not to mention these rotating strikes that seem to be jumping from industry to industry, I think this is sowing the seeds for another sort of inflation conflagration. So there are all sorts of really interesting cross currents right now, and I think the oil one is one to watch. I think that the last week or so showed how quickly oil. See, I wrote this at the end. I wrote a thread at the end of 22 called something like the lack of holy grails when you have like a inelastic supply curve. And I'm very fond of saying that the sword of inelastic supply cuts both ways, because when you have a near vertical supply curve as engineered by OPEC, if you have a sudden downward demand shock, you could have a very, very sharp spike down in price. And I think the short-term bulls tend to just think about inelastic supply, but I think of the danger that this geopolitical premium it represents, in that it kind of undid the real tell, I think, was last week, where oil prices got hammered on nothing more than essentially a status quo statement coming out of OPEC. And of course, some people are saying that there are some rumors of the Saudi Arabia potentially doing a deal with the U.S., etc. The more I think about it, I think the more probable such a deal is, because if you think about where Saudi Arabia is now, they've got themselves into this uncomfortable situation, much like the BOJ, where they've got a yield curve control issue like the BOJ. For OPEC, it's KSA basically supporting all the free riders within OPEC with these unilateral 1 million barrel per day cuts. And so Saudi Arabia's full production capacity is closer to 12. They've been producing below 9. So that's a lot of forward demand, sort of spare capacity that's in the system. And they have no good exit strategy, because the only way that they can exit in the near term is into a darkening macro backdrop. And so I think if I'm MBS here, and there's now this war between Israel and Palestine, and potentially bringing Iran into the fold, from MBS's standpoint, who's really great at playing both sides, doing a deal with the U.S. is a bird that kills three stones, right? One, it gives them a face-saving exit from their unilateral cuts. Two, it makes them seem like the good guys, and maybe they get a security deal out of it. And three, maybe he gets better fist bumps this time. So anyways, those are my initial thoughts on this week's.
That's interesting, because we had Dr. Anas Haji on earlier, and he claimed that any kind of agreement with the Saudis and the U.S., the U.S. has explicitly excluded oil from the conversation. So he's of the mindset that there isn't going to be kind of an oil for security guarantee type of deal coming out between KSA and the U.S. But that's his perspective. I guess what I'm kind of surprised over this past quarter is just the recoupling that we've seen with oil prices, the U.S. dollar, and real interest rates. If you had told me that real interest rates were going to shoot up as much as they did in the third quarter, the Fed would remain vigilant and the dollar would spike, versus particularly against emerging market currencies, and the Japanese yen threatening 150 again, I wouldn't have expected or traded on the expectation that oil prices would have risen $20 a barrel. I mean, granted, anything can happen over the short term, but are you kind of surprised that we saw this sort of recoupling with oil prices, the dollar, and real interest rates?
Actually, I'm not at all, because the original piece the piece that I wrote back in 2021, which was the piece where I coined the term U.S. dollar wrecking ball, was it was I'm trying to look up the thread. I can't remember what exactly I named it. I think it was called Oil and the US Dollar Wrecking Ball. And I pointed out in I think it was, I'm trying to look it up on my own Substack. I think it was at the end of 21, if I'm not mistaken, that it was oil prices in the first place that started the inflation conflagration. Oil was the spark that lit a bunch of dry tinder. And I'm the first to admit that, the identification of the dry tinder is somewhat ex post now, because it seems more obvious with 2020 hindsight that I think that there are structural reasons for why our inflation has remained sticky for a very long time. I have a pinned tweet that talks about how I think there's 4 primary reasons why the U.S. economy's resilience is causing the Fed to essentially out-hawk the rest of the world. So I think phase 1 of the U.S. dollar wrecking ball was driven largely by oil being the spark that lit the inflation conflagration back in 21. Oil was the spark that let inflation kind of jump into stickier components, which then started burning and stuck. It was oil that basically made the Fed then abandon team transitory and start taking it very seriously. And so that was the leap that I had made back in 21, saying that this would cause the rate differentials to widen between the US and other currencies. And that was a very contrary call at the time. I think what we're seeing now is a bit of a replay, but driven by slightly different factors. What's interesting now, I think, is that the resurgence of the dollar wrecking ball is coming from the same rate differentials, but in the opposite direction. Now, the rate differentials, I think, are being driven by a combination of, one, a realization that the rest of the world is going to start outdoing the Fed, not the Fed out hawking the rest of the world. So for these 4 reasons of these 4 horsemen of economic resilience, I call them the demographic and structural component. There's a we in the U.S. are less rate sensitive, both on the consumer and at the corporate level than much of the rest of the world. 3, there's obviously this huge fiscal tailwind that is directly at odds with the monetary headwinds that the Fed is trying to engineer. And then 4, we are the largest oil producer currently, and oil is denominated in U.S. dollars. So the U.S. economy is also more resilient to an oil shock than the rest of the world. But the rest of the world, look, Asia has been fighting the Fed the whole time. They've been easing even as we've been hiking. The real question is whether Europe and the UK can really out-hawk the Fed, and I just don't think they do. I don't think they have the same pillars of economic resilience that we do, and I think it's a matter of time before the ECB and or BOE start cutting well before the Fed does. So I think that's one component of it, and this time also there's the component that we're finally starting to see bear steepening, which is partially due to this recognition of higher for longer pervading all asset classes, including the long end of the curve. But I think it's also interesting to note that in the beginning, during phase 1 of the U.S. dollar wrecking ball, it was primarily the rate differentials that the world was primarily focused on were short rates, right? And just like in the middle of in the months leading up to the UK's gilt crisis, initially you saw the pound's relative strength being governed by short rates. And if anything, the blowout in long rates in the gilt market led to a dramatic weakening in the pound. Well, since they sort of dealt with their LDI issues, you've seen the opposite happen. And I kind of think that the regime here in the US has flipped that way too, where you're starting to see the bear steepening as a result of this H4L recognition, but the bear steepening itself is making people focus on rate differentials along the longer part of the curve. So there's a little bit of a reflexive loop there too. So
Thanks for that, Michael. Wall Street, you have your hands up, and then Rocco.
Thank you for the opportunity. The question what I have here to anyone who can answer is this: with the US physical deficit expected to double in 2023, which we have seen reaching approximately $2 trillion, and national debt continues to rise, how do you foresee these economic challenges impacting the value of dollar in the global market? And do you believe there are impending risks to the dollar status as well, our primary reserve currency, and how might this affect international trade and investments? Thank you.
So I think a general question is at what point does the bond market kind of act as that final governor on fiscal constraint? Is there a point where the deficit to GDP gets too big, even if we get all the California October tax payments coming in to help alleviate that? Does it get to a point where the bond market basically says we're going to call a strike here unless the fiscal house is, or at least unless the fiscal impulse is slowed down somewhat? Or do you think that at least over the next year and so forth, that really there is no governor on fiscal deficit spending?
can I take a stab at that?
Sure.
So look, at some point, I think it might be an issue, but today is not that day. And it's not going to be that day for a long time because we live in a world of relative value and relative balance sheets, and et cetera, et cetera. So as dire as the U.S. fiscal situation seems relative to our whatever metric you want to look at, our GDP, what have you, it's still a relative game in the world. And the US is still the cleanest dirty shirt with respect to so many different factors. And I think one issue that people don't think enough about is comparing stock to stock versus stock to flow. Because when you look at a metric like debt to GDP, that's a measure of stock to flow, right? GDP is a flow. The amount of debt is a measure of stock on the right side of the national balance sheet. Why don't people focus on the left side of the national balance sheet? How do you put a price on the natural resources of the US, on the availability, near unlimited availability relative to population of of our arable land and our water resources, et cetera? So like the problem with looking at these questions in a vacuum is exactly that. And so when you look at how far the Bank of Japan has been able to kick their specific can down the road, and they are in a situation with far less, geographic assets on the left side of their balance sheet, it tells me that this doomsday scenario that all the gold bugs and the Bitcoin bugs are playing for will not be in our lifetimes. And so I just think that that's a lot of hyperventilation that, it might drive a narrative or a newsletter subscription, but you're not going to see that in our lifetimes because that can get kicked much, much further than people think, especially because we live in a relative world. And relative to other national balance sheets and national economies, the U.S. is still the cleanest dirty shirt.
near term at least, do you see some sort of spending resolution happening beyond November 15th, the 45-day window that former Speaker McCarthy was able to negotiate?
I just don't really care, to be honest. It doesn't inform any of my trading or investment decisions.
Fair enough. So, Rahul, I'm going to have to bow out here in a couple minutes. Any final thoughts or observations you want to share?
One quick question, Benjamin. I have, sorry for Michael, is what is his input on this? One last question, what I have, sorry. With the noticeable adaptation and what we have seen with the gold and similar commodities in the global market, what implications do you foresee for investors and economists at large? How does this trend align or conflict with the current financial climate? And what strategies should investors consider to navigate these changes effectively, please?
Uh, can you maybe tighten that question a little bit? I'm not quite sure where you want to go with that. You're asking, it sounded like there were three different questions in that question.
Yeah, I'll repeat it. We have seen like central banks are moving towards gold and they're adapting more gold. They're accumulating more gold. The one question is related to that. Similar to the commodities in the global market, where now I hope oil and other resources, that how we are going to trade when the dependency on the dollar is going less and less. That's impact of how they are going to treat these. That's my second question at large from the economic perspective. And like, how do you think in this financial climate, what we are seeing, uh, how we need to actually make.
Okay, I think I kind of get the gist. Let me try to address that. So I guess just speaking for myself, and obviously this is not a recommendation. I'm just talking about what I'm doing. I think that equity markets right now are just mispriced relative to what's happened to the risk-free rate. And obviously, when I refer to the risk-free rate, I'm talking in business school parlance, right? The risk-free rate, which I call as the linchpin of all things financial, or I've also referred to it as the bottommost Jenga block of the risk edifice, right? That bottommost Jenga block has become wobbly and has repriced. Now it's repricing not for the reason that a lot of the dollar doomsday scenario people are saying. I think that the long end was due for a mispricing. I've tweeted out a number of times where on Koifin, for instance, you can find this great relative value chart of twos, tens across a number of different geographies, and relative. Our twos tens curve was as inverted as 110 basis points negative. And we have the strongest economy out of, and my points of comparison were, Japan, China, Germany, Italy, and so based on cyclical and macro reasons that have nothing to do with loss of faith in the U.S. Treasury or even the quarterly refunding surprises that many people key off of. I think that our level of yield curve inversion was so out of whack relative to our economic strength that it had to reprice. And the reason for that is actually the inherent safety bid premium in the UST, right? I think that's what's kept our yield curve inverted more than it should have been. So we're seeing a little bit of a repricing of that. But I think that to your question about gold, I think that right now because risk-free rates have gone up so much all along the curve, most risk assets have not yet priced have not yet repriced appropriately. I certainly feel that way about equities. So I've basically been, my trading account is, I kind of view my trading account as primarily a hedge account against the rest of my net worth, where I have a lot of real estate and, a bunch of, fund holdings and this oil and gas, private equity, et cetera, right? So my hedge book tends to be a very aggressively positioned, my trading book tends to be a very aggressively positioned hedge book for the rest of my net worth. And in it, I've been short. I've been short pretty much everything from equities to gold to oil through XOP. And I'm using option structures. Because I do think the reason why I've been bearish gold is that I think that in an era of high interest bearing money, the only real safe haven is that high interest bearing money, because at the end of the day, I have a contrary opinion on gold. I think that gold, my friend Alex Dahl has done an interesting regression where he showed a couple of months ago that, given where real rates are, not even where real rates are today, but real rates, say 6 months ago, he thought that the long-term regression for gold was around 1,200, given the current level of real rates. And the reason why it's holding much higher than that has been due to geopolitical flows. And so you can read that both ways, right? If you're a gold bull, you're going to say, well, see, hey, this is an example of how all the central banks are stockpiling on hard money and blah, blah, blah. Well, I have the opposite view. I feel like the fundamental, the real natural price for gold should be actually much, much lower. And if you have a situation where you have a dollar shortage around the world and the central banks need to sell a bunch of a range of reserve assets, well, the easiest reserve asset to hit, given its liquidity and elasticity, is U.S. Treasuries. So I'm sure there's some of that. But if they do need to sell some of their gold reserves, that's a highly inelastic commodity. A little bit goes a long ways. And I just don't like that trade. So actually one of my best trades over the last 2 weeks has actually been GLD puts, delta neutral on those now. But I just don't, I think that after the geopolitical fears subside a little bit over the weekend, I think you're going to see that gold's going to struggle in an era of high real rates. So I don't know if that kind of answers your questions.
Yeah. Do you mind if I respond to that? I've heard Michael talk for quite a while, put out some very interesting information, and some of it I agree with. And I think I look at things a little differently, because I don't look at things as a U.S. centric or Middle East centric or European centric. I just look at the numbers. And what's interesting, while the United States the economy is pretty robust, well, there's no coincidence since they raised the debt ceiling, we've added $2 trillion in debt. That's 4 months. You can do a lot when you add $2 trillion in debt. And so you've got the Federal Reserve raising interest rates, trying to get demand down. And at the same time, you got the U.S. Treasury issuing, or the government issuing more debt, and you've got to issue more treasuries. And so the thing is, what's going on? And I just mentioned in my first part of my talk that when you get PG&E, Pacific Gas and Electric, having a 10% interest expense of their revenue in California, that just goes to show you things are starting to get out of hand. Now, while there's a lot to be said about the Treasury market and gold, we could spend a lot of time on that. But in my analysis of the gold price, and it's been a 50-year analysis ever since the 1970s, the gold price has never gone below the gold miner's cost of production. It's never done it. Now, it could always be the first time. And my analysis of Newmont and Barrick, the top 6 gold miners, last quarter, it was about $1,710. So there's a reason why these commodities are priced a certain way. They're just not priced out of thin air. If you want to buy gold, you're going to have to pay what the gold miners are going to pay, what it costs them to produce it. So while I do agree with Michael that we could see lower gold prices, I've been telling my subscribers we're probably going to see lower gold prices, and we may even get down to 1750. And that's actually the 5 EMA on the yearly chart of gold. So I do think we are going to see lower gold prices. Are we going to see 1,200? Or Harry Dent Jr. He puts a stink bid in for 450. Well, if you want to bankrupt a half or 2/3 of the gold mining industry, then you can get down to those numbers. But I don't think we're going to get down there. And may I continue?
Yes,
you spoke. Let me. Yeah. So in my Silver Symposium, I showed since the global financial since the 2008 global financial crisis, that's when the global economy broke. And you know why? We peaked in conventional oil. Actually, last year, conventional oil production, conventional, is down 7 million barrels a day. Now we've brought on tight oil and heavy oil and natural gas liquid. So to someone who's naive to the oil industry, it doesn't look like peak oil is here. But the conventional provides the high quality diesel. So there's no coincidence. Since 2008, the global debt has increased twice. It's just no coincidence, because we're in serious trouble with oil. And so we've made it up with other energy sources, and the United States has been the leading factor. 85% of the growth has come from the US shale industry. But what Michael hasn't mentioned, while Saudi Arabia can cut oil, with the raising of interest rates, you have just destroyed the US shale industry business model. That was really only feasible with zero interest rates. And so now that they have gone through 5,000 of their DUCs, drilled but uncompleted wells that they drilled up to about 2020 during the pandemic, they went through all those. That was not a capital cost on their balance sheet. Now they've got to drill and complete, and the data is they're cutting drilling rigs. We all know this. They've been cutting oil drilling rigs for the last 3-4 months now. And that's not the shale industry. They're profit oriented. With $90 oil or 85, why are they cutting drilling rigs? Well, I just did a graphic showing all the wells in the Bakken, all the drilling wells from 2006 to 2023. 93% of the production comes from 4 counties. 4 counties. And if you see a time lapse, those 4 counties are getting all, you see it, they're all getting used up. There's not many areas you can put new wells. And this is the issue. The thing is, the Fed and the US Treasury can print money, but we can't print drilling locations. And we're starting to run out of these. And the only growth area is the Permian, and that's rolling over. So in conclusion, there's a lot more trouble coming than Mr. Cow is putting out. And I'm just showing you, I'm just saying the real information. And so I think the problem going forward is I don't see the US Treasuries as a safe haven if we continue to add $2 trillion of debt every year. That's just common sense for any economics professor.
thank you. Let me just respond. I actually agree with you in the long term on shale. By the way, that's why I have this long term bet on. But what I think is, I agree with you that that every basin has rolled over except for the Permian. The Permian is slowing down, but I would challenge you to say that the reduction in rig counts, though, is kind of a tricky metric to look at, because just in the junior private equity that I'm involved with, we have been in development mode for the last several years with just a handful of rigs, but we're drilling 3-mile laterals. And when you have a stacked zone that's got 5 zones, you don't need a lot of rigs in the Permian to generate a lot of oil. But that's not going to last. And I agree with you. And when I presented the paper at West Point in February, I talked about how, there was this mistaken notion that were it not for COVID, that the U.S. would be producing 15 million barrels per day now. And I was just shaking my head. I'm like, that's totally the wrong take. I think we're very, very close to peak production here in the U.S. Okay, so let me just set the record straight. I think long term, the whole reason why I have this long term private equity play on is exactly to capture the economics that you're espousing longer term. What I'm concerned about is the darkening macro backdrop, very, very in the very short term, the 6 to 12 months. Because I'll note what made me get cautious in April of 22 was as oil was closer to 110 back then. I think it was notable that Lakshmi, my favorite oil analyst from Capital One, she had put out this comparison to the 2007-2008 period, saying that, look, even in 2008, oil demand, actual demand, had only dropped by 500,000 barrels per day. But that's not what you need to focus on. You need to focus on the delta between expectations of growth and actual demand. So there were expectations of 2.5 million barrels per day of growth that got zeroed out, and then a 500,000 barrel per day loss got lumped in on top of that. So it was the delta of almost 3 million barrels per day relative to expectations that caused oil to completely collapse like that, right? So that is a scenario that I think is potentially plausible, especially if you have Saudi Arabia, who has been doing the heavy lifting, find some kind of exit strategy to get out of their unilateral cuts. So I think of like the Q4 18 and first half of 2020 as examples where you had a very tough macro backdrop, but then you also had a scenario where the big producers within OPEC plus, or back then there wasn't even the plus within OPEC, right? It was the plus within OPEC plus only came after this horrible market share war after COVID. So bad things can happen to a long-term fundamentally bullish backdrop. Now, I just want to address 2 more things that you talked about that are unrelated to oil. One is you're talking about our fiscal situation. I think my pushback always, though, on that is that's an extrapolation out into the future that we're always going to have these high rates. Part of what the Fed is trying to do here is to stop a potential wage price spiral in its tracks. And I have a very unpopular opinion, which is I actually think they should not have skipped the last hike, and I think they should hike in November. Yes, they are going to break things, for sure. But what do you think is going to happen when GM and the UAW strike a deal that's up 35% from, the previous? And what kind of precedent that sets for Kaiser Permanente and other industries? You're talking about locking in structural wage inflation for years. So that is what the Fed needs to nip in the bud. And by doing that, it sets the stages for another easing cycle. So I think that, so I think it's unfair to say that, oh, well, these fiscal deficits are only going to just explode. The can be kicked a lot longer than you think, especially when you look at the BOJ and the world of relative value comparison. Finally, to your point on gold, you could talk about the economic costs of like gold miners all you want, but at the end of the day, there's no DCFing an ounce of gold. Gold, like Bitcoin, is a chameleon trade, right? Its value is in the eye of the beholder. And so I guess my issue with that is that if you're talking about a long-term inflation hedge, there are much better asset classes. Stocks are a much better long-term inflation hedge. They actually generate economic rents and actually ultimately have a promise of redeploying dividends back to you. It's a asset that you can actually value, just like real estate as well, right? So the problem I have with gold and with Bitcoin is that they're trying to be all things to all people all the time, and how do you falsify the thesis exactly? So, I just think that in an era of ZERP, where anything shiny and has some element of scarcity becomes an object of speculation. In an area of anti-ZERP now, that order becomes a much tougher order. And so you really have to think about what is good value in a world where risk-free rates are 5.5%.
I'll just take one response, and I think it may be. I understand where Michael Cow what he's saying, and it's like things remain true until they don't, right? And what was the Federal Reserve telling us in Bernanke back in there was no subprime problem, right? And so we all know the party line. I mean, we're not stupid. And so when Yellen says that she wants to come out and put the price cap on Russian oil of 60, I mean, you look at our leaders and you think, how insane can they be? I mean, it's really, I'm looking for good leaders, and I just don't see them.
Yeah,
Like
I did not understand that comment at all.
I know that it just doesn't make sense. And she's a bright woman. I believe she's a very bright woman. So I don't know why someone would say that unless it's politically motivated. So the thing is, I guess it comes down to my fundamental view about energy, in which I spoke at the Silver Symposium. And basically, I looked that the world is going to have serious problems with energy. Now, Michael might disagree with me, but if you're going to have serious problems with energy, which is the main driver of the economy, the biggest problem is the finance. And I've got a chart from 2007, and I started at 2007. It's zero. I look at the GDP, it grew 28 trillion. That's what the GDP grew. The oil consumption in the world grew 13 million barrels a day. Now, the correct economists will tell you there is a direct one-to-one relationship between energy growth and GDP. But the economists don't seem to get that, unfortunately. But it really is proven, and it really is true. And the problem is this: if the GDP has grown 28 trillion, according to the Financial Stability Board, on their report on the shadow banking system, total financial assets have grown 280 trillion in the same period. So what I'm trying to get people to understand, we just have enough energy to put fuel in our car, to heat and cool our homes, to run the businesses, and to provide the goods and services that we all consume every day. And that's the GDP. We don't have the future energy to settle 281 trillion of additional finance on top of 200 trillion that was there before. So I have a fundamental different opinion than Mr. Cow, because I know energy drives the market, and energy gives us the value in goods and services. Unfortunately, the finance is supposed to help bring these goods and services to the market. They're not supposed to be a piggy bank, because before the global financial crisis, there was 5 trillion in outstanding treasuries. Now there's 25 trillion, and that's growing rapidly. Why do we need 20 trillion more in US treasuries? And that was there to fund our annual deficits for the last 15 years. And so basically, and everyone else is doing it. It's just not the United States. Okay, everyone else is doing that kind of business model. It's not just the United States. We just have the reserve currency. But again, to conclude here, My fundamental difference is with the world's energy industry hitting the Red Queen syndrome, and I can prove these numbers, we're losing a Saudi Arabia every year to the natural decline rate. And I can prove those numbers. 10 to 11 million barrels a day are lost every year. And we have to spend new money, new capital, new wells to replace that. You go back 40 years ago, it was 1.3 million barrels a day we had to replace. Now we're replacing 10, 11. And in a few years, it's going to become very difficult, even though we've got more supply coming on in different places. And so that's why I'm just trying to get people to understand this is too much finance, folks. We don't have the future energy to settle all these finance that's outstanding. And that's why we're going to move from building wealth to protecting it, whether people disagree with me or not. I think in time, that is going to be the more realistic outcome.
By the way, our long-term views are very much aligned. I don't know why you keep painting this rift that doesn't exist. That's the whole reason why I have a long-term.
Then why did you block me on Twitter?
Because probably you're being a jerk. That's the only time I block people. To be honest, I don't know.
Am I being a jerk to you right now?
No, but I don't remember. I mean, I block people. You block me, so I'm not going to get into he said, she said. But I mean,
okay, that's fine.
I block people when they're trolls, right? And so I don't know. Maybe you're not. But it has nothing to do with taking a religious view one way or the other, okay? Zero to do with that. My point is that if you have a long-term bet, you just got to make sure that you have the wherewithal to stomach the macro cyclicality. Because obviously, if you've been in the oil markets as long as I have, you could very well be carried out long before you see your long-term thesis play out. So that's the point. There are very, very sharp macro cycles that can happen, and you don't want to, I don't want to give people the impression that because there is a long-term, a very long-term bullish call on oil that you can't get absolutely hammered in the short term because of other macro factors, just like 1998, just like 2008, just like 2018, just like 2020.
Yeah, and I'm not concerned really about the price action. Well, I think the price action, it's going to be, this is how I put it, and I mentioned this before. There's no coincidence from 1960 to 1970, the world added 24 million barrels a day of oil production, mostly conventional. That'll never happen again. It was a one and done. And that's the reason why the oil price stayed at $1.80 for a whole decade. And you can kill JFK, and we could have the Vietnam War, the Cuban Missile Crisis, and assassination of RFK, and the Arab-Israeli War. All those things could happen like they're happening now. And it didn't even impact the price. Now, when I call you hit this energy cliff environment, this plateauish of environment, that you get the massive volatility.
By the way, I just unblocked you, okay? Just FYI.
Okay, so. and if I block, I tend to, and listen, Michael, I tend to block people who block me, and that's probably silly and childish, but I will unblock you because we do see eye to eye, and I'm the type person, if I'm wrong, I will admit it.
100%.
But
same here.
And I think the biggest thing that's missing from the equation is there's way too much finance, and there isn't going to be enough energy.
But let me ask you this though, okay? So because the end point, the end game, I believe that you are playing for, is the same end game that I have also been searching. I call it the supply-demand singularity point. Now, I personally don't think we're there. It sounds to me that maybe you think that we're there. Am I right?
I've been putting 2025. That's Europe hit natural gas in 2021. But I think the world global oil industry hits it in 2025. And that's just the beginning. Again, nothing happens overnight, right? I'm not talking about the end of the world. I'm just saying that we're not really going to be able to increase much supply after 2025.
Well, look, I can see that scenario playing out. In fact, a couple of months ago, I wrote a piece called, I think it was like a deep dive in the oil supply demand singularity. I'll post it in the nest if I can find it. But it was doing a deep dive with my private equity management team, also looking at global decline rates. I peg global decline rates a little bit more conservative than you. I'm using, I think, closer to like 6 or 7 million barrels per day, but that's a big fucking number. And so I do think that at some point that we can hit that point. But what I have been lambasting OPEC Plus about is, and the reason why I keep calling their cuts as premature emasculation, is because I think that to the extent that they keep artificially holding up the price and not letting it get rinsed where it needs to, it is just going to push out that oil, that supply demand singularity point further and further out. And the further out you push it, the more danger there is to it never happening, meaning that countries like China and India are able to find substitutes, through primarily other hydrocarbons. I'm talking about oil specifically. You might be talking about the overall energy cliff, but I'm talking about oil specifically when I talk about the supply demand singularity point.
Okay, and thank you for unblocking me. And no, I didn't block you. So I do appreciate being able to see your tweets again. And this may be important for the listeners to understand. The 6 to 8% number for the decline rate, that's very important, because everything we do in the world is consuming energy. You shut the energy off, there's no economy. And so if you understand the data, and so the large oil fields, it is true, it's about 6 to 7%. That's the real number. However, OPEC is only 38%. Non-OPEC is 62%. And a good part of that non-OPEC, which is the United States, which is close to 19 million barrels a day when you include natural gas liquids. When you include the U.S. shale industry that loses 45% a year, and they got to make it up every year, and then that is 4 million barrels a day lost just from the United States. And if you add the natural gas liquids, it's even more than that. The non-OPEC growth has come mostly offshore, deep water. Those decline 10% a year. So when you understand that the decline rate, unfortunately, the oil industry is not really looking into the change of the decline rate. My number is at least 10 to 11% a year. So if it's 100 million barrels a day, it's 10 million barrels a day gone. And about 40% of that, Michael, is the United States, because the top 4 shale fields, they lost 3.2 million barrels a day that they had to make up this year.
By the way, I just shared my post in the nest, and I'd be curious to hear your thoughts when you get a chance to go through it. I think you'll find it fairly balanced. I'm not being very Pollyanna-ish, but I don't think I'm being overly bearish either. So you'll see.
Oh, okay, I don't see it up there, but I will look into it. I just think I just think the declines that are coming, and again, as you do know, a typical large field goes into a growth mode, like Guyana, like the Ghawar field from Saudi Arabia. It goes into growth mode, then it plateaus, and then it goes into the decline mode. Well, most of OPEC is there now. And so they have to add more wells to keep that decline from really declining. And so you just put these numbers together. I don't want to continue on this. I think the listeners have heard enough, but I think the declines are much larger. And we'll see if I'm wrong in 2025, 2026, and we've passed the recession and we're up to 1.2, 1.4, 1.5. I'll admit I was wrong. So, time will tell.
Pretty interesting and intense discussion. I'm glad you guys unblocked each other. Weimar, anything to add before we close here?
Yeah, hopefully I can get some people blocking me. But I actually just wanted to ask the opinion of Rocco and Michael maybe about the spread to the physical market in Shanghai that we're seeing for gold right now. It's like an interesting new dynamic in the market that hasn't been there before, and I think their gold market just reopened yesterday, and that spread went pretty much right back to its all-time highs. So, what do you guys think of that development?
I haven't focused on it,
Well,
so I'm not going to
well,
comment.
from what I know, it's similar to what the Indian government does to the Indian people by increasing the import duty, and that cuts demand. What the China's doing the same thing. They're the ones that are doing it. They're trying to limit the purchase of gold for a while. So that's why there's that premium for the gold price in Shanghai. It's not that the markets are broken. The Chinese government is trying to manage how much gold is being purchased due to the problems they're having with the currency, and the same thing the Indians do when they raise the import tariff on gold and silver, and they just did that again this year. So these are the things that kind of fluctuate in the precious metal markets.
So you're saying it's more like a currency control balance of trade type thing?
Yeah, again, the Indian government does it. So China, from what I understand, they're trying to limit the gold purchases, and so when you do that, you see it show up in that premium. I don't think that's going to last. It could get worse, and so I don't know, but I actually do think we're going to see new highs in gold next year. And so if I'm wrong, I'll definitely come back in here and say I'm wrong. But I think we're going to see new highs in gold next year, probably above 2,200.
Yeah, and I would just say on Sunday, the data came out, or maybe it was the day before, China had bought another 28.6 million tons of gold, 28.6 tons of gold, and this would have been the 11th straight month of buying that they've done. So it's clearly a trend now, and it's just interesting.
Yes, it is. So, well, what's really fascinating, and we could see this dynamic change early on when gold was money. It was mostly the Western countries that held most of the gold, and then to kind of prop up the dollar, we saw the London gold pool, and then the United States was selling a lot of gold, and then Nixon dropped the dollar peg because we were just getting rid of too much gold. And so then the inflation took off in the 70s. And then in the late 90s and early 2000s, it was the Western central banks that were selling gold into the market. And then when that ended in 2009, what happened to the gold price? And since 2009, it's been mostly the Eastern central banks that are Eastern Asian that have been buying gold. Some Western banks, not many, but it's mostly Africa, the Middle East, and the Eastern countries, India, China, Russia, buying gold. So that's just the dynamic. That the Western countries are holding on to their gold. They're not continuing to sell it, but that's the dynamic that's been taking place.
Yeah, and two European countries that are kind of buying gold are Poland and Hungary, Poland in particular lately.
Thank you, Weimar. Thank you, Rocco and Michael and Benjamin, of course. Really great session today. Lasted much longer than I had anticipated, but we had a lot of good speakers come up, from Mike Green and Dr. Nas earlier to the panel we have here. So definitely want to give everyone a quick shout out and appreciate everyone for tuning in. We'll be on again Thursday morning at 8 a.m. in front of CPI. Have a huge panel lined up for that, so definitely give myself and Benjamin a quick follow if you don't want to miss that session, because that's something that's going to be a big data point this week that's coming out. Of course, if you enjoy these sessions, you'll most likely like my newsletter as well, which is totally free. It's pinned above. And then Ben's a frequent contributor, sharing great insights on the markets, and we tie up a lot of news events and different information that people typically care about on a day-to-day basis. So you can subscribe to that as well. It's pinned above in the nest. Thank you, Michael. Thank you, Rocco. Thank you, Weimar. Thanks, Ben. And appreciate everyone for tuning in. We'll be back on Thursday.